question or visit SearchGo to find answers now.
Very close to all-time highs on the S&P 500. Futures pulling back just a little bit. We're down 0.17% on the S&P. Yields are a little bit lower by not even a basis point on the 10-year, 411.62. Under surveillance this morning, President Biden hitting the campaign trail.
The experts from the time I got elected were insisting that a recession was just around the corner. Every month there was going to be a recession. What recession? Growth ended accelerating in 2023. Thanks to the American people, America now has the strongest growth, the lowest inflation rate of any major economy in the world.
President Biden looking to capitalize on the robust fourth quarter GDP report, the latest Pew poll showing a 9% increase in Americans who have a positive view of the economy compared to a year ago. But Biden's overall approval rating, Anne-Marie, remaining at just 33%. We'll be hearing a lot more from both Biden and Trump in the coming weeks as they prepare for the South Carolina primary on February 24th.
Yeah, absolutely. The economy is still ranking large, Jonathan, when it comes to why voters want to go to the polls. Greg Valliere is discussing this morning in his opinion piece. He's talking about how weighing in on how critical Biden will be connecting to the economy for those voters. A better economy with data to support the improvement is a big deal. This looks like a Goldilocks economy, and if Americans finally begin to believe that, Biden has a decent chance. Let's see.
Get to Greg Valliere right now, the Chief U.S. Policy Strategist at AGF Investments. Greg, let's start there on the economy. Anne-Marie's asked this a few times. Is the calendar on his side? The moves we've seen in financial markets, developments in the economy, do you expect that to show up in the polls anytime soon?
I think it's a good question, John. I do think the calendar is on his side largely because had these great numbers come out in June or July or August, it might have been too late. But we're in January. And I think over the next 2 or 3 months, there'll be more data confirming that we're not going to have a recession. And that news comes at a pretty fortuitous time for Biden.
If the economy is doing better and Americans do start to feel better about the economy, Greg, what happens next for that issue that's neck and neck for the economy and top of voters' minds, immigration? Because what we're hearing right now in Congress, that potentially a deal will not get done.
Well, I'd say, first of all, Anne-Marie, that if Joe Biden loses re-election, I think it'll be because of immigration. He's not handled it well. He doesn't really have a plan. But this is compounded by the new Speaker of the House, Johnson, and, of course, Donald Trump, who are urging their colleagues not to act because they don't want to give the Democrats a victory. That's pretty cynical, even by Washington standards. But I do think that we won't get a deal. The intriguing question is, can we get a separate deal that gives money to Ukraine? I do think that could happen.
When it comes to Mitch McConnell, there's a lot of reporting that behind closed scenes, he basically said, capitulating on this deal that he was pushing for. Is there any chance you see before November, potentially him being able to rally the troops in the Senate and get something done on immigration, given all the work that's been put into this? And the Republicans might lose a generational moment in time to get something done.
I know, but I think they view the election and a big election issue as more important. I think the key variable here is going to be, do we get another big surge like we had before Christmas? I mean, we were getting like 10,000 illegal immigrants a day before Christmas. We had nearly 2 million last year. If the numbers start to spike up again, then I think that would be an incentive to do something.
You mentioned Speaker Johnson. He also has a really tight rope to walk when it comes to this potential tax bill, as well as what that's going to mean for child credits. Does he put that on the floor?
Well, it looks like he's not anxious to get any kind of a deal, and the hardline conservatives in the House don't want him to do anything. He's on a very short leash, as you know, and I think that if we see Johnson not cooperating, he could suffer the same fate as Kevin McCarthy. He could get the boot.
Given the fact that Trump has kind of gotten clearly the leadership position, he is going to be probably the person running against Joe Biden, does it make it less likely that we're going to get anything done in Congress, that we're going to get some sort of government shutdown, that there's going to be this real fissure that just gets accelerated because any deal just simply will help Biden look better, which could really harm, potentially, Donald Trump?
Yeah, I tell you, Lisa, I think it makes it more likely that we'll get nothing done, that they won't want to give Biden any kind of a victory, and they'll just spin their wheels, do nothing. Again, as I said, I'm pretty cynical, but even by my standards, this is really cynical.
We started on the economy, and we're going to be getting the core PCE deflator later today, which is the key inflation metric. What do you think this administration is getting wrong in messaging?
I think they probably don't appreciate the psychological damage that was done to many Americans during and right after the pandemic. I think they were quite nervous about their own personal budgets, and that hasn't changed yet. I think the public is still of the belief that the economy is not good. I was at a conference earlier this week of retail investors, and I was telling them I thought the economy was getting better, looking good. They thought I was crazy. They thought I was delusional. So there's still a strong opinion that the economy is not good, even though I would argue the numbers lately have been quite encouraging.
It's hard when inflation hits groceries to the degree that it has, and that seems to be what people have been talking about. We did hear from Janet Yellen yesterday at the Economic Club of Chicago, and she was talking about prolonging some of the tax cuts from the Trump era. What do you make of this, sort of this concern about the deficit on one hand and a need for fiscal responsibility, and then talking up tax cuts in a new push on the other?
I think you could make a compelling case. We should do nothing. Everybody's saying let's cut taxes, let's spend more. No, I don't think this economy needs any more stimulus. I don't think it needs any more spending. I don't think it needs any kind of big new tax cut, maybe a small one on the child tax credit. But I think if it ain't broke, don't fix it. And I think there's a temptation in Washington to overreact to every problem.
Let's talk about what is broken, just to wrap it up, Greg. Plenty of things are broken, but this specifically, the lessons from New Hampshire and the ability of the former president to attract moderates. Greg, with that in mind, is he thinking about a running partner that can do just that for him?
I thought the exit polls were really significant, John, in New Hampshire. It showed that a lot of moderates don't like him. A lot of suburbanites don't like him. He has very bad numbers. And I think there's a compelling case that Trump cannot win the election just with his base. He needs to expand that base, and there was no sign that he did that in New Hampshire.
So when he says things like, if you donate to Nikki Haley, we won't accept your money, Greg, what are the chances that he actually will?
He'll take their money. I think that's a hollow threat. But I think the relationship now between Haley and Trump is so poisoned that her chances of being the vice presidential candidate are very slim.
Anyone in mind, Greg?
Yeah, let's watch two people who I think are ambitious and may move. One is J.D. Vance of Ohio. The other is Elise Stefanik from upstate New York. They're both passionate Trump supporters. They're both articulate. They're young. And I think you're going to hear a lot more about the two of them.
Greg, good to hear from you. Greg Valliere there of HF Investments. Thank you, sir. The view from the administration coming up a little bit later this morning. Wally Adeyemo of the US Treasury joining us at 8 a.m. Eastern Time. That's the lineup. AMH, let's talk about the names that he just threw out there. What do you think?
Well, what's interesting is, as Greg said, those names are already within Trump's base. So if he's looking at these numbers, and to Greg's point, New Hampshire showed he has issues with some suburbanites, he has issues with independents, then you really need to go outside the 30% MAGA stronghold and get someone that relates to them, like Nikki Haley, but potentially has the fuel already been blown up between those two in their former relationship, that's not possible. But if you want to get the entire party, he needs to look elsewhere than Elise Stefanik and J.D. Vance.
I've actually read Hillbilly Elegy.
So did I.
Yeah, it was an interesting book, and it sort of gave a window into where he's coming from.
You know what's funny about that book? The liberal left loved that book.
I know.
And then he started getting into politics, and all of a sudden they don't like the guy anymore, which is, it's kind of funny.
Well, it's a question of policy versus story.
Sure.
And there's a question of how you bring people together through a story that a lot of people could relate to.
Coming up in the next hour, Mohammed Al-Arian of Bloomberg Opinion, Sarah Hunt of Alpine Saxton Woods, the brilliant Bob Michael of JP Morgan Asset Management. They're all brilliant before anyone gets jealous. All of that in the next hour from New York City this morning. Good morning.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, a significant challenge that we are confronting, and my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
DOJ or other authorities
Who face bigger challenges next.
It was going to keep Green World Cup. This is a 3
As the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
We're at a point now when we're expecting the broader market to really do well.
You may not be seeing the broadening out if you just look at tech, but if you look at the dispersion that's happening in the Magnificent Seven, it tells you that something is brewing.
For the market, still this disinflationary trend, I think, is the #1 story.
We've taken the punch bowl away, and markets haven't fully adjusted.
This is just an unprecedented economy, and we have to manage a bunch of different factors.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
We are on the longest winning streak since mid-December on the S&P 500. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowitz, together with Anne-Marie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500 just a touch softer, lighter, lower, negative by 0.1%. It's been all-time high after all-time high all week this week, and it's not just the equity market. Lisa, it's the credit market too.
Basically, everything rallying. Credit spreads globally now at the lowest levels going back 2 years. People basically coalescing around this idea of a soft landing. All of the data pointing to stronger growth and more disinflation.
The White House has been absolutely loving it. The President of the United States trolling everyone who called for a recession. The Treasury Secretary Janet Yellen saying the bad part of the inflation story is over. Is that going to translate into the polls through the year ahead?
We have to wait and see. So far, the polling that we've seen, Biden continues to get poor remarks when it comes to the economy. Americans are not yet feeling this disinflationary scenario. But again, the timeline might be on their side. The Michigan Consumer Sentiment Survey that was recently out, although that is a little bit partisan, depending on you ask Democrats or Republicans what they think about the economy, they answer where some of their political lines lie. But the fact of the matter is, Americans are starting to feeling a little bit better, but can they sell this going into November?
I keep reflecting on a couple of conversations I've had with Uber drivers, and I'm not going to base my entire thesis on that. But one guy said, you know, $5 used to be able to go in the store and it would buy you something that you could actually eat. And now it really can't in the same kind of way in the city. And that's really problematic. It's making him feel really negative. So people say, well, it'll just take time for people to adjust to these. Is there enough time before November for people to adjust to prices at higher levels than they were, say, in 2020?
This is the challenge of communicating this, and I think you're absolutely right. For consumers, it's about the price level. It's about the adjustment, the cumulative inflation we've seen since 2020, and we've talked about the scars of that. What Diane Swonk said recently, and we're all fans of Diane Swonk, you need this labour market to stay pretty decent. You need wage growth to continue climbing. You need time, to your point. The problem I've got with the economic data at the moment, Lisa, and we're both on the same page about this, I know, so much of it is in conflict. So headline payrolls data looks good. Beneath the surface, the breadth of the gains is really narrow, just a couple of industries. I think you see this in earnings too. Let's take Visa yesterday, compare it to, say, Capital One. We both look at the same thing. Visa saying consumer spending remained resilient. What stands out for Capital One? I'll tell you, borrowers falling behind on their credit card and auto loans. Which one do you think speaks to where the American population is at the moment?
It's the one of LVMH versus Kmart. That is what we're talking about essentially, which is that people who have money will keep spending and be able to pay for it. People who have to borrow at 10% rates to buy a car are having trouble with underwater loans paying it back. And you're seeing that in the Capital One figures, not necessarily in the Visa figures. And these disparities point to a much more complicated picture than simply the headline numbers suggest.
We've seen that conflict all year, haven't we? Here's the broader price action for you this morning, at least, and good morning to you all at home. The equity market on the S&P 500 negative here by 0.1%. Into the bond market, 411.43 on a 10-year. Into the FX market, just in and around 109, 108.75. Lisa, we heard from the ECB yesterday. I wonder if the message is going to be any different from Chairman Powell and the Fed next week.
She was echoing Jay Powell from December, which is essentially whatever the markets are saying. I don't usually go back on them. She didn't push back. She could have pushed back, and essentially now we have a 90% pricing of an ECB rate cut come April, a 50 basis point rate cut in total being priced in by June.
Shima Shah says that summer's going to come early because if Christine Lagarde continues to be data dependent, as she says she is, then her date is going to have to change.
Going to have to move forward, potentially to the spring. At least she's not going there just yet. What did she say yesterday? I didn't talk about rate cuts today, but what I told you before still holds? And they talked about rate cuts?
She says she stands by her words, but also, and we didn't cut the full version of that, it was a Bloomberg reporter asking her, and she said, but how you interpreted what I told your TV channel is a little bit different than what I said, but I stand by what I said, which was likely summer.
Okay, super helpful that, super helpful. Over the next 60 minutes, the programme looks like this. Mohammed Al-Erin of Bloomberg Opinion and Queen's College, Cambridge on the resilient US economy. Sarah Hunt of Alpine Saxon Woods with stocks closing in on a third week of gains. And JP Morgan's Bob Michael on the Fed's path forward. We begin with our top story this morning. Better than expected data boosting optimism for a soft landing.
Just last week, we saw the biggest jump in 30 years in how positive consumers are feeling about the economy. Things are finally beginning to sink in. We passed a lot of really good legislation. We knew it was going to take time for it to begin to take hold, but it's taken hold now and turning the economy around.
But Mohammed Al-Arian of Queen's College, Cambridge, writing earlier this month, the Biden administration cannot simply rely on lower inflation to alleviate voters' concerns about its economic management. It needs to communicate more effectively the exceptionalism of US economic performance. Mohammed, I'm pleased to say, joins us now for more. Mohammed, good morning. I think you're right on the money. Nailed it. This is a big, big issue for communication in the White House right now. Can you give us what you think they should do in the weeks and months to come?
Sure, John. Thanks for having me on. They have to translate things that they've achieved and that the public doesn't appreciate. Amazing job growth, very strong economy. You know, remember, even Bloomberg said 100% probability of recession in 2023. Instead, we've ended up with a 5% third quarter, a 3.3% fourth quarter. Remarkable. Stock markets, record high. And it's the only advanced economy that is investing in the drivers of tomorrow's growth. That is a long list of achievements. And yet, if you ask the person in the street, and Marie talked about the polls, they think that the administration has mishandled the economy. There's two reasons for that. One is inflation. You're absolutely right. People think in terms of price level. So for them, when you say we are winning the war over inflation, they think that that means prices will come down, not that the rate of price increases will come down. And the second thing is they haven't communicated in a manner that translates this to the everyday. So you need a lot more consistent communication, and you need it simplified so that the person in the street understands why not only are they better off than they've been before, but the prospects is that we have new growth engines coming in.
I'd also argue, Mohammed, you need the labour market to hold up for the rest of this year, to allow the scars of inflation to actually heal. Do you think the easing of financial conditions over the last few months, let's go from the end of October, Mohammed, do you think that's sufficient to delay any weakness in the labour market?
I don't, because a lot of this is like pushing on a string. Corporates will be able to refinance at lower rates, mortgages slightly better, but the reality is that there's structural issues. I mean, that is the big risk for the administration, is that the economy slows this year because some of the drivers of last year's growth are no longer there, including high savings. And secondly, inflation stops going down. You know, John, I've said we are in the sweetest spot of the inflation reduction right now. It's going to get tougher going forward. And we've already seen from Europe that it's not out of the question that not only does inflation stabilize, but once in a while you get the rate going up. And that would really impact perceptions.
The White House is so excited to lean into this, Mohammed, soft, very soft landing expectation. The timeline may be on their side, but when you look out to November, where are the vulnerabilities to that soft landing?
So the vulnerability, there's three of them. One is what the external world is imposing on the U.S. It is getting harder to grow in this global environment. We have disruptions of supply chains. We have cost pressures in the pipeline. We have delays in shipments. All that has a marginal impact. Two, the consumer is going to be under more pressure. You've talked about debt levels in the previous hour. Savings have come down. We no longer have the pandemic savings being utilized to the extent it was before. So there's a real risk that growth slows to the 1 to 1.5% level, with downside that we may slip into a negative quarter. And then thirdly, inflation. We need inflation to keep on going down. The market expects that it will do so in a much more orderly way than I think will materialize, unfortunately.
I'm struck by something. I keep thinking about this. Cameron Dawson said, Mohammed, where she was saying she's checking for pricing power among a lot of companies that are going to be reporting earnings. If they don't have that much pricing power, that's great news for disinflation. That's very bad news for their bottom line in terms of just their margins. How much is this sweet spot for disinflation not necessarily a Goldilocks spot for a lot of the stocks that are getting bid up simply because it means margin compression down the line?
Oh, and you're seeing it. I mean, you know, my big theme for this year is dispersion. And just look today, we're realizing that not all tech is tech and not all luxury is luxury. That is what the results are telling you between Intel, on the one hand for tech, and on the other hand for LVMH. what you're seeing is growing dispersion. And some companies will have pricing power, others will not. And we are going to see this dispersion. Now, the market right now is betting on a very aggressive rate cycle, allowing for everything to go up, because that is the experience since the global financial crisis. As long as the Fed loosens, everybody benefits. I think this time around, we're going to see a lot more dispersion than we've seen before.
Deutsche Bank says we'll get a reality check later this year. They're looking for, say, 10% downside on the S&P 500. It's not particularly unusual. Are you expecting that kind of reality check, Mohammed, anytime soon? For markets, given where stocks are at all-time highs, spreads, global credit spreads, incredibly tight.
You know, John, I'm not in the business of predicting whether it happens and when it happens. And where people have been wrong in the past, including last year, is ignoring the technicals. And the technicals right now are incredibly favorable. So the big question for me is what breaks favorable technical? By that, I mean there's still money in the sideline that can be put to work. So dips will be viewed as buying opportunities for a while. Look, John, the thing I worry about most is the sense that growth is going to disappoint with a downward risk, the balance of risk on the downside. This comes against the universal romance with the softest of all soft landing. And then secondly, a recognition that the Fed is not going to validate what's being priced in right now in terms of cuts.
Chairman Powell next week, what kind of message are you expecting? The one we heard from Williams a few days after he spoke in December, or the one we heard from Powell at the December news conference?
Or the one we'll hear at the beginning of the press conference versus the one we'll hear at the end of the press conference. I don't know.
True. It's been confusing, Mohammed.
Sorry?
It's been confusing.
It has been confusing. Part of that is that this is a confusing time. You know, people that I talk to privately, expectations, John, are all over the place. There are people who think they won't stop, they won't cut rates until the summer, and then we'll get 75 basis points. There are people who think they'll start in March and they'll front load it because of the elections. There are people who think, like me, that they're likely to wait until much nearer to the summer and then start with 25 basis points. Expectations are all over. And what's really interesting is that forward guidance has lost its power. The Fed has been very clear in terms of its forward guidance, and the market's saying, yeah, sure, but I'm not going to listen to you. That's really problematic.
You said you're not in the business of predicting the future. Can I just jump in and get you to predict the future? When's that first rate cut coming, Mohammed?
My own gut feeling is that it will come at the beginning of the summer, so call it June, maybe July, and it will be 25 basis points. And not only do I think that that's what's going to happen, I think that that's what should happen.
Okay. Mohammed, appreciate your time today, this morning. Thank you, sir. As always, Mohammed Al-Erin of Bloomberg Opinion and Queen's College, Cambridge. Lisa, what do you make of that?
Just the idea that this is what they should and this is what they will do, which means pushback, and frankly, it means a lot of repricing in the markets. That's all I can say. Because right now, you have a significant lean, about a 0.5% chance, 50% chance of a rate cut come March.
Not in the business of predicting the future, but we got him to predict the future just a little bit towards the end of the conversation. Equities right now on the S&P 500 negative here by 0.1%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hackers. Hey, Yahira.
Hi, John. The Biden administration has frozen approvals for new licenses to export LNG. Officials say they need time to scrutinize how shipments affect the climate, the economy, and national security. The halt will likely disrupt plans for billions of dollars in projects. President Biden saying, quote, "This pause on new LNG approvals sees the climate crisis for what it is, the existential threat of our time." Some major U.S. chains are dealing with a growing number of Middle East consumers boycotting Western brands over America's lack of action to try and end the Israel-Hamas war. McDonald's and Starbucks are among the companies affected, while one local Egyptian soda brand said its sales have tripled since the war began, as consumers boycott Coca-Cola and Pepsi. Shares of LVMH are surging after the luxury retailer saw sales rise at the end of last year. An increase in sales of handbags produced 10% growth in revenue over the final quarter, with the company's billionaire CEO saying he was, quote, very confident for the year ahead. That's your Bloomberg Brief. John?
Yahira, thank you. Coming up next on the program, volatility on the horizon.
a higher volatility backdrop, both in terms of the macro conditions, including inflation, and the market, I think should be part of the assumption as we, continue in this year.
That's coming up next on the program, live from New York City. You're watching Bloomberg Surveillance.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Six-day winning streak on the S&P 500. We might just snap that. We might. On the S&P, we look like this. We're negative 0.05%. We're going absolutely nowhere in the equity market and in the bond market too on a 10-year 411.24. Under surveillance this morning, volatility on the horizon.
You got volatility so low that to some degree it's just a simple reversion to the mean. You can only go so much lower before you see it turn back up in volatility. So a higher volatility backdrop, both in terms of the macro conditions, including inflation, and the market, I think should be part of the assumption as we continue in this year.
Between mixed messages from the Federal Reserve on interest rates, geopolitical instability, and the presidential election less than a year away, investors are bracing for the unpredictable. Sarah Hunt of Alpine Saxon Woods writing this: the growth in earnings and drop in rate scenarios needs to find a common narrative. At the moment, it seems difficult to square the circle of a market looking for both 10% plus earnings growth and deep cuts in interest rates. Sarah Hunt joins us around the table. Morning, Sarah.
Good morning.
So it's your job to square the circle, please.
I don't think we can, and I think this is the biggest issue right now, is that you've had this big move up in multiples. You've got this expectation that the Fed is going to cut rates, at least from the market's perspective, more than the Fed is telling you. You've got this growth in earnings while you're seeing fourth quarter earnings coming in fine, but the expectations going forward so far have been a mixed bag, and for many people are just pulling guidance. So how do I square that and say, okay, that should all be fine, and risk assets should just be able to keep performing well in this environment? And I think Cameron made a really good point earlier on margins, which is one of those things that we've been looking at and saying all these things that we're doing are not positive for margins. How does that help?
So which part of the rally are you leaning against the most? Which has gotten ahead of itself?
Well, the parts that have gotten ahead of itself are still the parts that you can't ignore, like the tech sector, right? Because some of those earnings really are growing that quickly. So in some cases, something like NVIDIA, yes, it looks like it's had a huge move and it's grown enormously, but you look at the cash flow that they're supposed to generate and you go, okay, actually, relatively speaking, it's not as crazy as it looks in some other areas. I just think the entire idea that you can just keep pushing risk assets higher while you're looking for all of these minutiae that's going on and the rest of the world not doing that well, it just seems a little difficult, but it's hard to pinpoint exactly where the problem is. Otherwise, you could just say, well, I'm going to short this or I'm going to short that. And it's tough.
Now for the psychology portion of the program. I'm curious how much this is just really a reversal of what we saw last year. That people were so pessimistic and they got it so wrong that now they feel like all of their sort of little voices in the backs of their heads saying, oh, this looks a little concerning. They got to kind of ignore that because it has been a nirvana economic outlook, at least so far this year.
Yeah, and isn't that usually where the narrative changes, when everybody decides that it's okay and it's really different this time and that's all right? I mean, we fight with that ourselves all the time, which is, you know, are we really in this situation where you've got different drivers of market performance, you've got different buyers of equities, you've got hedge funds, you've got macro funds, does that really change the underneath? And when you finally start to say, yes, the fundamental picture has changed, well, the world tends to be, you know, gods of copybook headings come back and say, well, maybe not exactly. So the answer is I'm not really sure. And I think that you've got some time in the near term, but you've got all this stuff coming up in March. Does the Fed really cut? What do they telegraph? What happens with the BTFP, with it expiring? There's a whole lot of things in the underneath that also make it figuring. I think that you're going to see, to Liz Ann Saunders' point, some more volatility.
So, Sarah, what do you like right now?
Well, like I said, we like some of those big tech names that people are that have moved a lot. I mean, the NVIDIA's been a big move, but there are some areas that we think that are really, you've got some good cash generation. Some of the other semiconductors are quite expensive relative to NVIDIA right now. And I think that even though we like them going forward, because we just think that you're going to continue to increase technology, some of those areas are tough. And we, you know, there's places in the environment that we like. We like Train, you know, we like the Carrier. We like some of the areas where you've got this giant HVAC replacement cycle that's going into the environmental stuff.
Lisa and I were talking about the conflict in the data and also the conflict in the earnings. I think it's really important. Just look at Visa yesterday. Consumer spending, resilient. Then you go to Capital One, and they're talking about borrowers falling behind on their credit cards and auto loans. And I'm trying to work out, if I was an investor right now, do I want to own consumer discretionary in America? Is that a story I want to buy?
Well, this is exactly goes to the point of LVMH just having great numbers, and people like Capital One who have, on the credit side, are starting to see some issues. Discovery started to see some issues on the credit side, the auto loan side. You've got a huge bifurcation in the consumer, and you've got a high-end consumer that's doing fairly well, and you've got a low-end consumer that, to the whole point of this economic backdrop, price levels are still very high. You know, yes, all those things that Mohamed El-Erian was just talking about in the economy that are good, but it doesn't matter if I'm struggling to put groceries in my cart and everything is so much more expensive than it was.
Just to build on that kind of narrative, we also got American Express just moments ago, and they said that, yes, write-offs not so great, but they expect much better earnings because of robust sign-up to some of the premium cards. So again, it's catering to that richer kind of class. I want to go back to this idea of margins then, and sort of the margin compression and pricing power. At what point is disinflation, which is good for the economy and particularly for lower income families, at what point is that very negative for a certain slew of stocks in terms of their margins that you're watching?
There's always an issue when you've got price level changes for somebody. It's good for somebody, it's bad for somebody else, right? You drop oil prices down, all of a sudden refiners have a good couple of quarters. There's always the input depends on who the input people are and who the output people are and which prices are actually falling. So it's going to be an issue, but I think that margins in general, you've got a lot of cost structures that are going higher. Wages are going higher. They might not be going as high as inflation, but they're going higher. If you can't get continued price increases, which I would argue the automakers are having trouble doing. I mean, look at what Tesla just did. Look at some of the areas that are big. Some of the tech stocks, it's not so much of an issue because if your input into something's ultimate manufacture is a small part of that price, it's much less of an issue than if it's a big part of that price because everyone's trying to cut costs.
What about some of the winners, the airlines, the cruise liners, some of those kinds of areas where it is discretionary spending and there's a real big mix of potential clients?
Well, on the airline side, it's tough because you've got capacity changes all over the globe that are sometimes hard to track and sometimes conflict with where people think that they should be, right? So the U.S. domestic has not been as good as international because there's been additions in capacity on the airline side. There's plenty of places where people are spending money. The question is there enough capacity restriction to make that price for people able to raise prices, which I'm losing my words, but you know what I mean?
Don't worry, it's early in the morning. Let's finish on the autos if we can. We've been doing a round trip. It's like stock market roulette at the moment, so let's finish on the autos. Tesla was down 12% yesterday. This feels like a really difficult moment, and I don't want to just say just for Tesla, I mean the whole industry in America right now, going against the low-cost producers out of China at a time when labor costs, particularly for Ford, Stellantis, and GM, are moving in the wrong direction for them. How investable is that sector at the moment, from your perspective?
I think it's very difficult because I think you're looking at an area where you haven't had as much consumer demand because interest rates have gone up, so now cars are even less affordable. Insurance is going higher. There was a story on insurance because cars are more expensive to fix and there's a lot more technology in them. All of these things are driving it to be a much more expensive proposition than it used to be. I think for Tesla, you've got this interim period where they're now promising a more low-cost vehicle to compete with other things, but also because I think you had a huge range of first adopters in EVs, and now EVs seemed a little bit stuck, and all the automakers went all in on EVs because they were told to, mostly by the government and everything else. I think you've got a lot of cross currents. It makes it very difficult to parse what the underlying real fundamentals are.
Bramo, January 26th, and I think we're down about 26% year to date for Tesla. It's been a brutal start to the year.
And that press conference didn't really help, especially with Dan Ives saying that basically it was a train wreck and then a plane crash, and then he just said, it's an understatement. So
but
at
he's
this
still
point,
bullish.
Well, for now.
Yeah.
Wedbush just removed Tesla from their best ideas list. Just
Interesting. So that's a subtle shift.
There's like a subtle shift that's going on under the cover.
Hey, Sarah, it's good to see you, as always. Thanks for being with us in the new studio. Sarah Huntner of Alpine Sexton Woods. Coming up next on the programme, looking ahead to the Fed meeting, Bob Michael, JP Morgan Asset Management for the next 30 minutes on Bloomberg Surveillance.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it? Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Brace yourself. Bob Michael, JP Morgan, showing up with attitude, real attitude in a commercial break. He'll be with us in just a second. Equity futures on the S&P 500 look a little something like this. We're negative here by 0.07% on the S&P 500. 6-day winning streak, the longest since mid-December, extending the longest winning streak, daily winning streak of the year so far. On the Nasdaq, we're down about 1/3 of 1%. The Russell, the small caps, up by 0.4. In the bond market, 2-year, 10-year, 30-year, much more on treasuries a little bit later in this segment. We're unchanged on a 10-year, 412, on a 2-year, higher by a basis point or two, 430.97. And just to finish on foreign exchange, ending the week basically where we started the week and ended last week, around 109, 108.70 on the euro, positive by 0.2%. Under surveillance this morning, Treasury Secretary Janet Yellen touting the U.S. economy, telling the Economic Club of Chicago that inflation is, quote, well under control, and that most Americans would agree.
People are getting ahead. They're seeing their fortunes improve. And I believe if inflation stays low, they'll begin to regain their confidence in the economy.
Another read on the U.S. economy coming in just under an hour, with personal spending and the PCE core deflator due at 8:30 Eastern time. Would most Americans agree with that statement?
Not if you look at the polls right now, which are all red when it comes to Biden's approval on the economy, on inflation. Look at this. Economist YouGov poll. This was done January 21st to 23rd. -21 spread on inflation specifically. So it's not catching up to Americans just yet, but maybe it will. And I think she was leaning into that.
I also thought her comments on tax cuts were really interesting. They prolonged them, especially given some of the focus on reducing the deficit and how to distinguish from the former President Trump.
But only with a nuance. If you make $400,000 or less, which we've heard Biden say this a lot, but if you're a little bit above that bracket and Biden's reelected, it's going to be very difficult to get those Trump-era tax cuts through.
Speaking of Donald Trump, going after Nikki Haley and Nikki Haley's campaign donors, saying anyone that makes a contribution to his GOP rival will be, quote, permanently barred from the MAGA camp. I'm not sure how many people believe this. Losses in Iowa and New Hampshire leaving Haley with little chance of winning the GOP nomination, but that's not stopping the former president going after her donors, who contributed around $50 million to her campaign in the second half of last year, slightly more than what Trump received. Anne-Marie, we heard from Greg Valliere of HGF Investments, and I said, will he actually follow through with this? And he just said flat out, no, not a chance.
What politician is going to follow through when a billionaire calls you and says, I can help fund your campaign? And campaigns in America are very, very expensive. I thought what was so interesting about the campaign financing of both these super PACs is Haley brought in more, $5 million more than Trump did, but potentially that's going to start to evaporate.
The other unusual dimension of this, of course, if you look at the lessons of New Hampshire, the inability of the former president to attract moderates. There are some people who believe the perfect running mate would be Nikki Haley. How much do you want to poison the water over the next few weeks?
It seems like Greg Valliere, just to lean on his comments, didn't seem to think that that was a likelihood.
Not happening.
And honestly, after some of the commentary back and forth, it doesn't seem likely. That said, the problem with independents really raises some questions for the Trump campaign.
Well, if Trump wants to win, he might have to look outside a potential MAGA running mate and get someone that's more in the middle so they can actually encompass the entire party. If he has Nikki Haley, she can go out and talk to women living in suburbs. That would help him a lot.
That's the politics. Let's pick out a single name. We've been talking about LVMH. We've talked about Intel as well. LVMH is rallying hard. Intel is not. It's down about 11%. Shares of Intel tumbling after the chipmaker delivered a disappointing forecast, renewing doubts about a comeback for the once dominant company. Intel expecting first quarter sales to come in around $1 billion shy of estimates. The CEO, Pat Gelsinger, saying the company has a lot of work to do. Gelsinger joins Bloomberg Technology at about 1 p.m. Eastern time. What are your thoughts on that, Bramo? Intel's in a tough spot, isn't it?
Yeah, given the fact that profit, they're expecting in the first quarter 13 cents a share versus the expectation of 34 cents a share. You know, we were talking about this with Ed, and it is a mix of what your products are. But to Mohamed El-Erian's point, the dispersion of the haves and the have-nots, it's not just to go into tech. It's to go into the technology that is most leveraged to the current, sort of feel in the business world. Those dispersions are getting greater and greater, which makes it more challenging to really have an overall call that percolates down to the smaller companies or bigger companies.
Well, for Intel, they're just not in the right space, in the right spot right now.
And they're not gaining traction. And how much can you really get a competitive edge when there is already that critical mass in some of the other
chip makers and some of the other tech companies.
Intel is plunging, the broader stock market recovering, equity futures right now just about unchanged, counting you down to a Fed decision next week. The data continuing to show a resilient US economy. Bob Michael, Global Head of Fixed Income at JP Morgan Asset Management, writing this: whatever the mirror image of stagflation is, that is exactly what we wound up with. Let's call it economic nirvana. Given the momentum, it's difficult to imagine anything other than trend growth ahead. Bob Michael joins us now. Morning, Bob.
Good morning.
Good to catch up with you, sir. We're not going to talk about Liverpool yet. I'm going to save that for the end of the segment, okay? So just wait for that. Let's talk about bonds and the Federal Reserve first. And this economic backdrop, this is a big change for you. I remember being with you 12 months, anticipating that, 12 months ago, anticipating that hard landing. Not anymore. Why do you think this can continue?
Well, 12 months ago, there was every reason to expect recession. There were rate shocks delivered. Everything looked frail. I would argue in March we had that recession with the collapse of the regional banking system, but the policy response was overwhelming at the time, and within a couple quarters we realized it was more like a TARP moment than anything else. So things were stabilized and we took off again. And I think as the year has gone by, businesses and households have managed to absorb the higher level of prices. Yes, they don't like the higher levels of prices, but we're in a disinflationary environment, not an inflationary one, and unfortunately not deflation just yet. So it looks good. I'm tempted to see how much of a high five Jay Powell wants to give himself in the Fed next week.
You think there might be a victory lap?
They're entitled to it. When you look at it, it cannot possibly get better than this. You've had 25 consecutive months of unemployment at 4% or lower, and I guess we'll get another update in about 45 minutes or so. But when you look at the last 6 months of core personal consumption expenditures and annualize that, 1.9%, that's their 2% target. They are there.
I'm not expecting Chairman Powell to walk into the room and start high-fiving Mike McKee anytime soon. I don't think that's ever happening. But Bob Michael, what do you expect he will do next week? Is he going to tee up rate cuts in March, given what you've just said?
I don't think in March. I think June is where the market has gravitated to, and I think that's a good marker for him to put out there. I like what Christine Lagarde did, which is to acknowledge that there has been improvement, that they can think about things, that the level of rates is substantially pulling inflation down, and there's an opportunity to make a shift. When you look at the real Fed funds rate, the Fed funds rate's 5.25% to 5.5%, and if you're around your 2% target, the real Fed funds rate is 3.25%, 3.5%. That's way above what the Fed is telling us is normal.
So how much is your whole idea predicated on the idea that the new normal looks a lot like the pre-pandemic old normal? That you push back against the idea that we're in a structurally higher inflation world that's going to force the Fed, yeah, even if they start cutting rates, they can't cut them that far.
I think that's probably true. I think the last 15 or so years were the anomaly. For sure, us baby boomers blew things up in 2007, 2008, when we learned to leverage everything in the housing market, and it's taken a long time to recover from that. But now there's a new generation coming along. Start with the millennials and the surrounding cohorts, and then suddenly they're not 17, 18 years old anymore. They're in their 30s, and they're the dominant earner, spender, and saver, and that's the environment we're in. Now, you just don't go up to 5, 6, 7, 8% and stay there. We've gone a long way. Things are slowing down. You could take some of the pressure off the system, let things stabilize in there, and then see where the economy goes and what you have to do with rates after that. That's more normal to me.
So if the Fed can't cut rates as far as maybe in the past, or even as people previously thought, just simply because the economy is managing with rates where they are, how do you reason around getting more aggressive in high-yield bonds, which have both a credit component that has gotten very tight and have the rate component, which may not be able to compress as much as some people expect?
So we think they could bring rates easily down to 3%. And if they'll only do that if they're at their 2% inflation target. That's a real Fed funds rate of 1%. And they've guided us to a real Fed funds rate of 0.5% is normal. We'll see as we head there whether that starts to shift. So that's 225 basis points of rate cuts. That's a lot. That takes a lot of pressure off of corporate America. And a lot of corporate America funds itself in the floating rate market, either through banks directly or through private credit markets or bank loans that are syndicated, things like that. It also takes a lot of pressure off of the consumer. Things like housing, maybe that starts to pick up in earnest again. And a lot of the borrowing that's gone on to revolving rate credit cards, that pressure comes down. So you do get a good level of consumption. It does remind me of 1995. And credit spreads can go to 300 basis points in high yield, trade from 275 to 325, and stay there for years.
Bob Michael, you're going to stick with us. We'll expand on that conversation. Some big calls and a big change for Bob Michael at JP Morgan Asset Management. Constructive on credit. Here's a snapshot of financial markets for you. Equity futures on the S&P 500, almost totally unchanged. Let's get you an update on stories. Elsewhere this morning, here's your Bloomberg Brief with Yahira Hackers. Hey, Yahira.
Hi, John. Shares of American Express jumping after posting its fourth quarter earnings. The credit card giant is sticking to its long-term revenue goal while missing profit and revenue estimates. Amex is still aiming for annual revenue growth exceeding 10%. Meanwhile, Visa saw an 8% profit increase in the last quarter. Apple is revamping its App Store and iPhone features in the European Union. The overhaul is an effort to appease regulators in the region, which are set to impose new antitrust rules. Still, the tech giant is mounting a legal challenge against the Digital Markets Act through the EU courts. And Liverpool manager Jurgen Klopp is stepping down. The football club chief said in an interview posted on X he will leave the club at the end of the English Premier League season. Klopp has been at Liverpool since 2015, winning 6 trophies, including the coveted Champions League. He said he is, quote, running out of energy. That's your Bloomberg Brief. John?
Yahira, thank you. Had a tweet moments ago. Could we get a moment of silence this morning for Klopp leaving Liverpool? Massive shout out to Anne-Marie wearing red in solidarity. She knows. She definitely knows. AMH. Bob Michael, tell us your thoughts. Liverpool fan. Jurgen Klopp.
The first thought is shock and horror. It's brutal, particularly when you're a bond fund manager and been through a 2-year bear market, now this. But the reality is, he did us proud. He brought us back to the top. You heard 6 trophies. So I wish him the best. I don't think he's done. I think he winds up managing a national team.
Oh, really? You think that's where this is heading? Germany?
I'm hoping the U.S. or England.
That's where you think this is going?
I don't know where, but someone with his talent, he'll get restless after a period of time. And I think a national team's a good spot for him to
Well, he's still young. Unbelievable manager for Liverpool Football Club over the last 8 years or so. Bob Michael's going to stick with us. Up next on the program, the outlook for credit.
One of the really interesting things from my perspective is this kind of significant demand for corporate credit to start the year.
Constructive on credit, not just BlackRock, but JP Morgan Asset Management as well. That conversation up next.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities
could face bigger
Britain's next.
It was going to keep rate World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Live from New York City, good morning to you. Equities on the S&P 500 shaping up as follows. On the S&P, we're negative by just 0.03% after a 6-day winning streak on the S&P. Under surveillance this morning, the outlook for credit.
One of the really interesting things from my perspective is this kind of significant demand for corporate credit to start the year. Some folks are rotating out of short-term cash products into corporate credit. Some are rotating out of other asset classes. Some are kind of bringing their allocations back to neutral where they may have been underweight. So I do think that there's a broad-based kind of appetite to lock in all-in yields.
There is a lot of appetite. Bob Michael writing this: we retain a significant core holding in investment-grade corporate bonds and securitized credit. Credit spreads have narrowed, but history shows us they can stay there for a period of years. Bob Michael's back with us. Bob, we mentioned this just briefly. Let's build on it. What's changed for you in the last few months to become constructive now on various places in credit?
What's become constructive for us is that the probability of recession has pretty much vanished over the last couple of quarters. And if you're in a soft landing and in an environment where inflation is moderate and the Fed can bring down rates, that's great for corporate America. The financing pressure comes down, consumers are out spending. We've seen that the last couple of quarters. Credit spreads tend to come in. You want to be a holder.
We've seen tons of supply to start 2024. A question we've asked through the week, we asked it of Amanda Liner at BlackRock, and Priya Misra as well when we had the conversation about credit with her, your colleague. Is this catch-up from last year or pull forward for this year? How do you view the issuance, the supply we've seen so far?
I'm going to tell you something surprising. Between Treasury supply and corporate supply, I'm worried there's simply not enough. And I almost wish the Fed wouldn't start tapering QT. And I almost wish they would push out interest rate cuts a little bit further and go once a quarter instead of starting in May or June and doing every meeting. There is so much money looking to come into this market. You look where levels got to. Levels got here in credit spreads and yields simply with the money that's already in the market. I've not had a single conversation over the last couple quarters with a client who said, oh, get me out of bonds. Every single one is saying, how do I get in? When do I get in? Where do I get in? And you see it everywhere. You see it in money market fund assets. They're still at $6 trillion. You talk to corporate treasurers and pension fund CIOs. They're looking to de-risk. Everyone wants higher yield.
So this is a fascinating idea, the scarcity of bonds question, which has come to the fore a number of times in history. How much is this because a large chunk of corporate America are going to private markets to borrow and not to the public markets, so that there's sort of a limited pool of these types of securities?
I think that's some of it. I think the other thing that's happened is the backup in yields happened pretty quickly. Everyone wanted a bit higher, thought we would spend some time there, and then it's starting to reverse, so it feels a little like this time last year. So a lot of plan sponsors are a bit frozen, and rightly so. You look at the Treasury. The Treasury has moved a lot of its issuance to the front end of the curve. I would argue, put it out in 10 and 30 years, get those rates up or keep them where they are, allow people to get into this market who are going to be long-term holders. I think also private credit has served a lot of purposes. The most important one from our perspective, it's another avenue of non-bank lending that's materialized. And that's created a fantastic pool of capital that's available to backstop corporate America as well. So if you're a company, you can go to your bank. If you're large enough, you can go to the public markets. And the private credit markets are amply large as well.
What happened to all the zombies out there that were supposed to collapse in the wake of higher rates?
Well, you see it. There's just, look at the bun fight going on to finance Macy's now. There are so many different things that are happening that tell you there's so much committed capital that's waiting to be called and invested that nothing can really default. It just gets rolled over and restructured. I know it's insane to say that. I know we're going to have defaults, but as you're getting into an environment where recession looks in the rear window and where there is ample liquidity around and the availability of credit is everywhere, it's a pretty easy environment.
Where was this message back in October when the 2-year was 5.26 and the 10-year was through 5%? I don't remember people coming on the program and saying there's not enough bonds. I think they were saying there's too many treasuries. Why is it different this time? I mean, it literally was 4 months ago. I'm kind of sitting here scratching my head thinking there's not enough bonds. We've been complaining in the treasury market there's too much supply.
Yeah, I wasn't complaining about that. I was always one who was saying the worst decisions get made on supply and demand in the bond market than anything else. You just have to ignore it. But if you go back to September, there was still a lot of concern that maybe the Fed would come back and hike rates again. It was unclear what the Fed's message was. Now you've gone another quarter and a half, 2 quarters. The economy has done better than anyone anticipated, and inflation has actually done better than anyone had anticipated. And you've got that momentum heading into 2024.
You don't sound concerned about America's financing needs. This monster budget deficit, which could become a bigger monster in years to come, depending on who gets into power. But basically, whoever gets into power, it's a massive deficit. You're not concerned about that?
Not today, only because I saw the need for it. We had a pandemic. You needed an overwhelming policy response. We had that fiscal and monetary. Now we're coming out of the other side. We're still in the shadow of COVID policies. You have to work them out. You can't keep piling up on them. You've got to let them come down. So I'm all for that. But I don't think you bring it down all at once.
Let's build on that, this idea that maybe it's not this year, but next year, that people start to get a little bit more nervous, especially as interest expenses continue to rise and some of the expenditures that are just baked in continue to increase. At what point do you care about supply, or is it never really an issue? It's just a matter of what the yield is and the fact that people want to lock in income.
Well, we're in economic nirvana right now, and one of the things the Fed can do to keep us there is to start to bring rates down. And if you go back to 1995, that was critical to have a soft landing. They cut rates 3 times by 25 basis points, and that took some of the funding pressure off of businesses and households, and that allowed things to stabilize. So I do think that's a necessary ingredient. We can't just assume everything's fine now, let's not touch anything. We've got to start bringing rates down at some point in time. And then I think things look pretty good.
To John's point about fiscal deficits, we've seen a 79% increase since 2019 of debt to GDP. The CBO says it's going to be 118% in 2033. Is the U.S. going to get comfortable running Italy or Japan-sized deficits?
I hope not. I think every household, including all of ours, we have to balance our budgets every year, and I hope our federal government will do the same thing. I also think that ship has sailed. Coming out of the financial crisis, there was a lot of talk about financial repression and debt to GDP at over 80%, 100% takes so much off of GDP, and that hasn't proven to be correct. And in fact, when you look at countries like Japan, which have mid-300s debt to GDP, you can keep it there forever. I hope that's not the case. I hope there is fiscal responsibility in place over the coming years in Washington, and we bring it down. But I understand how we got here.
Mike McKee writes in, just subject header, nothing else. Ask Bob what my question should be next week in the Federal Reserve. This is a monthly tradition every time the Fed gathers. What should it be next week for Mike McKee?
Really? He wants it a week early on me?
I think he's worried you're not going to show up next week on Bloomberg.
No, I think actually I am back next week.
You're going to be back next week? Good.
Yeah, no.
We can do it twice.
I think he has to pin them in on how they view quantitative tightening and how they see the roadmap for that. And if there's enough demand for treasuries, then do they need to start quantitative tightening, or how much are they concerned about another repo incident that we saw in 2019?
Do you think we need to get through QT before we can start talking about cutting interest rates? Is that the sequence of things for you? Can we do both at the same time?
But both certainly help. If you think there are two very large sellers of treasuries out there, there's the Treasury funding the government, and then there's the Fed running down its balance sheet. That's another huge, you take one of those out of the equation by tapering QT, suddenly a headwind becomes a tailwind.
Mohammed was on the program in the last 50 minutes. He said he doesn't predict the future for markets specifically. He will with the Fed. Can you do that for markets? Talk to me about the bond market. Well, where do you see yields coming down to? I remember the call of 3.0 right through the curve, 2s out to 30s. Is that still the call?
So we're in the markets. We're investing client capital. We have to have a view. I can't sit here and tell clients, I'm sorry, we have no view. We've just plunked $800 billion into whatever happened to come across our doorstep. And our view is there is a soft landing. There's capacity for the Fed to bring rates down over time to 3%. That will still look historically high on a real basis. And in that environment, you can see the 2-year somewhere around 2.75% to 3%, and the 10-year 3.25% to 3.5%. So threes maybe not quite down to the 3% across the board when recession was a much higher probability.
Year end or year end next year?
No, I think once the Fed starts cutting rates with the money that's going to come into the market, it's going to happen this year.
Bob, this was fun. Economic Nirvana with Bob Michael of JP Morgan Asset Management and a whole lot more. Just a little sprinkle of Liverpool for the Liverpool fans out there. Bramo, we're going back to 3. Going back to 3. Not quite right the way through the curve, but getting close.
Bond scarcity. When was the last time that we heard
that's
that?
shocking, right?
The idea that everyone was worried about supply, it's the opposite issue. Everyone wants to get in, and there just isn't enough of it. To me, that really is a massive takeaway.
And that is a non-consensus contrarian call, I would say, based on what we've heard over the last 4 months.
Yeah, but a lot of people are going into credit, so they're buying it whether or not they know why.
Yep. Coming up in the next hour, Wally Adeyemo, the Deputy Treasury Secretary, Peter Cheer of Academy Securities, Tiffany Wilding of PIMCO, and Ellen Wald of the Atlantic Council. The third hour of Bloomberg Surveillance, up next.
You look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing, but what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried had pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop
until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
This is Bloomberg.
Rates right now are coming down. The only question is when, and I do believe that it's going to be pushed out further.
We are pushing back against the market's pricing swift, immediate rate cuts starting in the first quarter.
There is this very substantial disinflationary process in place. It's just a question of whether or not you get an uptick over the next several months.
A higher volatility backdrop, both in terms of the macro conditions, including inflation, and the market, I think should be part of the assumption.
People still worry about inflation, and there's just not a lot of data to support the idea that there is any.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Ferro. Your equity market totally unchanged on the S&P 500. What a difference a few months makes for the equity market. 6-day winning streak on the S&P 500. All-time high every single day at the close this week so far in the bond market. Yields were at 5%. Only back in October, right now on a 10-year 4.12, on a 2-year 4.32. The sentiment shift, amazing. Bob Michael, JP Morgan Asset Management, there's not enough bonds.
This comes after last year when he was expecting recession. Now we're in this sort of Goldilocks moment, this economic nirvana, as he called it. Look, everyone's done a 180, or a lot of people have. A year ago, people were talking about the impossibility of a soft landing. Dream on. And now people are saying, not only is it a soft landing, this is a no landing with disinflation and some cherries on top. I mean, at a certain point, you have to wonder how much more optimistic can people get.
That phrase, economic nirvana, we did not hear that phrase 12 months ago. It's all you hear at the moment. In about 29 minutes, 28 minutes or so, another read on US inflation just around the corner. Anne-Marie, that's one to watch going into the Fed next week.
Absolutely, especially when you have the polls continuously show that the data is not hitting how people feel about their pricing power when they still go to the grocery stores. One thing that is helping the administration, and Amos Hochstein was very proud of this yesterday, and we're going to speak to another U.S. official, is gasoline prices coming down. But will all of this be enough to change the perception of voters when it comes to November?
The whole idea of core PCE, the deflator figure that the Fed has been looking for, what do they need for an all clear? Right? How do they know that we're not going to get some sort of 1967, 1968 type of appearance of a soft landing with a resurgence on top? Not to be gloomy, but I do wonder, how do they sort of understand where the trajectories are going at a time where people are still spending on LVMH handbags and champagne?
It's not out of character at all, don't worry, to be gloomy. Let's pick up on what Bob said. Bob thinks they should be high-fiving, doing victory laps at the FOMC meeting next week. When I hear a lot of that, doesn't that make you feel a little bit uncomfortable about how quickly the pendulum swung from one side to the other?
If they do that, I guarantee they will be pilloried. They're not going to do that. That would not be very popular. I will say that at this moment, though, there seems to be a real acceptance. The fact that Christine Lagarde did not push against the market pricing the same way that Jay Powell did in December, he also did not push back. They're not even worried about financial conditions anymore at a time when Bob Michael's sitting there saying that you can get credit if you easily anywhere, and that no one will default. I mean, he was talking a little bit tongue-in-cheek, but it gives you a sense of how much things have shifted.
That's why, or at least part of the reason, stocks are close to all-time highs this morning. Equity futures on the S&P 500 negative here by almost 0.1%, but coming off the back of the longest daily winning streak of the year so far. Longest winning streak, actually, going back to mid-December on the S&P 500. had 6 days of it, down by not even 0.1%. Yields higher by, let's call it half a basis point on a 10-year, 4.1239. Coming up this hour on the programme, US Deputy Treasury Secretary Wally Adeyemo on the state of the economy, PIMCO's Tiffany Wilding reacting to today's inflation data and what it means for the Fed, and we'll touch base with Ellen Wald at the Atlantic Council on the politically charged EV debate and a little bit, Anne-Marie, on what's happening with LNG exports in this country.
Absolutely. There's a review the administration put out. They're basically kicking the can down the road for these new LNG exports, and this is very political. Within the administration, there's individuals like Podesta, Granholm, who wanted the climate side to win. And then you have the national security concerns of individuals like Jake Sullivan, Amos Hochstein with us yesterday. Biden made a pledge to the Europeans that we will supply LNG, given the fact that you can no longer get that from Russia. Yes, this is not going to impact LNG leaving the United States today, but it sends a different sentiment to that market.
We begin with our top story this morning, the Biden administration appearing to declare victory on inflation.
We have seen some turnaround in sentiment in recent months. The University of Michigan Consumer Sentiment Index has moved up quite a lot. Inflation is now near term at close to the lowest levels we've seen in that survey. So I think Americans do believe inflation's under control.
Secretary Yellen making the case for a soft landing as fourth quarter GDP tops estimates and inflation continues to cool. I'm pleased to say, joining us on this program exclusively, the US Deputy Treasury Secretary Wally Adeyemo. Deputy Treasury Secretary, wonderful to catch up with you again, sir, and to have a longer conversation about the US economy. Was that a declaration of victory on inflation yesterday?
So I was listening to the show before I came on, and you talked about all the people who have changed their mind. The truth is Secretary Yellen's been consistent. If you go back a year ago, she made very clear that we could grow the economy, bring down inflation, and keep a tight labor market, and that's exactly what we're doing. What she was saying yesterday was that we have seen progress made in terms of making sure that the middle class has more money to spend at the end of the month because gas prices are down $1.90. We know that there's more that we need to do in terms of trying to make sure that we put more money in the pockets of the middle class in America, and that's exactly what the President and Secretary are committed to doing. We're not declaring victory, rather we're saying we've made progress, and we're going to continue to make that progress going forward.
Deputy Secretary, why do you think there is such a huge gap between the sentiment and the economic indicators that seem to be making a really positive case for the economy?
I think the most important thing we have to continue to remember, and I just came back from a trip literally around the world, is that people are still impacted by the pandemic and the ways that it impacted their lives. But the thing we have going for us in the United States is that because of the work that our businesses have done, the American people have done, we're better positioned as an economy to deal with that. You think about the investments we made in things like the Advanced Child Tax Credit, which gave American families tax relief in the midst of the pandemic, and the relief that we gave to small businesses. And today we've seen 16 million applications for new small businesses in America. We're seeing progress, but what I know that has happened to the American people, but people around the world, is that the pandemic had an impact that has, in lots of ways, still continuing. But our economy is better positioned today than any economy of a major country around the world because of the decisions and choices the President and the Secretary have made. And our goal is to make sure that we continue from that position of strength to invest in the American economy.
Deputy Secretary, you're talking about getting more dollars in people's pockets, and we heard Janet Yellen, Treasury Secretary, yesterday talking about the potential for prolonging some of the tax cuts for people making less than $400,000 a year. How concerned are you that getting additional dollars in people's pockets will just fuel another round of inflation, which really gave people a lot of the negativity to start with?
I think the most important thing that we should look at is one of the biggest drivers of the inflationary pressures we saw in our economy was on the supply side. Supply chains were snarled, and you've seen a huge decrease in supply chain challenges in the economy. Energy is a great place to start. Just look at what we've seen in terms of the $1.90 reduction in the cost of gas. But throughout our supply chains, we've seen them improve to put us in a better position to meet the demand in the economy. And it's important to remember what the Secretary said. For the middle class, we're not going to increase their taxes. We're going to look for ways to provide relief to families, but we're also going to look to modestly increase taxes on the wealthy, on large corporations, because the Secretary and the President believe that over the medium term, we need to make sure that we have a fiscally sustainable outlook, which is very different than the last administration.
Well, you just got back from Japan, and I understand that CFIUS is still under review for Japan's takeover of U.S. Steel. We have the Prime Minister of Japan joining U.S. for a state dinner upcoming in April. Will we get a decision on this soon?
So as you know, we don't talk about any CFIUS cases if they exist or if they don't publicly. It's a private matter if there's a CFIUS case. What I can say is that CFIUS is a process that's been set up to look at national security risk and make sure that we in the United States, as we support foreign direct investment in the United States, we're also very mindful of the national security risk that some foreign direct investment presents. Stepping away from a specific case, one of the things that we believe deeply in is the importance of a strong U.S. steel industry. That's why we've made investments like the Inflation Reduction Act and the investments that we've made in rebuilding our infrastructure. And ultimately what we want to see is more companies like U.S. Steel in the United States that have union workers that are paid a good living wage, and that's exactly why we're making the investments we're making in the U.S. economy today.
But I'm looking at your readout, and it says the Deputy Secretary thanked his government counterparts for Japan's leadership. How is this a national security concern when it's one of the United States' strongest allies in the Asia-Pacific?
So as I said, I'm not able to talk about whether there is a case or isn't there a case when it comes to CFIUS. The CFIUS process is one that we'll work through and take some time, and I expect that any CFIUS case that comes through will be treated in a manner that's consistent with the law. And ultimately, Congress passed a law that gave CFIUS certain authorities, and we plan to do our jobs in terms of reviewing the national security risk of any transaction that comes before CFIUS.
One of the policies you were discussing, of course, in Japan was the future of what is going on with Russia's invasion of Ukraine. Where are you in the status of talks with your partners about Russia's assets? Do you see a legal path forward with Russia's stranded assets to give them to Ukraine?
Marie, as you mentioned, one of the topics of conversation amongst the G7 and our coalition more broadly is how we make sure that Russia compensates Ukraine for the damage they've done to their economy. Our leaders at the beginning of the war immobilized Russia's sovereign assets that were held in our countries so Putin couldn't use them to fund his illegal war. Now they've said very clearly that Putin is not getting back those assets until he pays for the damage that's been done in Ukraine. And they've asked us, experts amongst the G7, to think about what we can do to try and compensate the Ukrainians for the damage that's been done. In Europe, they're talking about things like windfall profit taxes. We're debating a number of other ideas, with the idea being that ultimately we need to make sure that Russia is the one that pays to help rebuild Ukraine in order to make sure they have a thriving economy as well as a thriving democracy.
Deputy Secretary, appreciate your time this morning. I just wanted to squeeze in one further question, actually about trade. The former president is on the campaign trail, talking about the potential of a blanket 10% tariffs on imports into the United States. This administration has maintained tariffs on China from the previous administration. What is your position on that now?
So I think that a blanket 10% tariff that isn't well targeted would hurt the American people. And what we've done, instead of looking to simply do blanket tariffs, is try to work with our allies and partners to hold China accountable for the things that they are doing that violate trade rules going forward. Because ultimately what we know is that the best way to make sure that China lives by the rules of the road that we've all set is by doing that with our allies and partners rather than taking a go-it-alone approach. And that's exactly what the president's going to continue to do.
Do you think that U.S. car manufacturers can compete with Chinese automakers without those tariffs?
I think the U.S. car manufacturers can compete with anyone in the world if they're playing on a level playing field. And the problem today for them is that in China, there are subsidies that are being given to not only car companies, but throughout the ecosystem that are making it possible to produce cars that are loss leaders. And ultimately, the reason that in the United States, but also in Europe, people are concerned about Chinese vehicles flooding the market is because they're being produced in ways that violate basic trade rules, and it's why we're looking at our options here. But I know that Europe is also looking at their options to ensure that we don't end up in a place where Chinese overcapacity floods our markets.
What do those options look like, sir?
Well, I'm not going to get into them with you here, but we're having serious conversations with our allies and partners to ensure that we're in a position to make sure that our companies are able to compete on a level playing field.
That's why we do those interviews, Wally. We try and make it happen. Wally, appreciate your time. Wally Adeyemo there, the US Deputy Treasury Secretary on the latest. Tell you what, that final point, this is going to be a big issue on the campaign trail. Can automakers in this country compete? Yes, if there's a level playing field, but let's face it, there isn't one. So what can they do? What are the options?
And this is going to be really ultimately what it comes down to, because right now, if you talk to anyone in the industry, there is no way they can compete if there are tariffs lifted or if some of the Chinese auto manufacturers are allowed to sell their cars in the United States.
Let's continue this conversation. Let's also get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. The Biden administration has halted the approval of new licenses to export liquefied natural gas. The U.S. Energy Department will study its effects on climate and the economy, according to a White House statement. The pause could potentially impact more than a dozen proposals now awaiting review at the agency. Senior officials have not put a firm timeline on the process. Blackstone is out to direct lenders for help financing its $2.3 billion acquisition of the online pet care company Rover Group. The firm saw about $250 million of private debt that would pay interest of about 475 basis points over the secured overnight financing rate. If successful, the borrowing would mark one of the cheapest private credit deals on record. And LVMH rallying after posting results that beat estimates. The luxury giant saw 10% growth in revenue in the last quarter, proving resilient amid a slowdown in the wider sector. Shares rose the most in almost 4 years as its billionaire CEO said he's, quote, very confident for this year. That's your Bloomberg Brief. John?
Yahira, thank you very much. Coming up on this program, up next, the rush into bonds.
Between Treasury supply and corporate supply, I'm worried there's simply not enough.
There's simply not enough bonds. That conversation up next. Live from New York City, you're watching Bloomberg Surveillance.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
A little more than 1 hour away from the opening bell in New York City. Equity futures on the S&P 500 look like this. We're negative by 0.08%. Bonds are totally unchanged in fixed income in the Treasury market, 411.81 on a US 10-year. Under surveillance this morning, the rush into bonds.
Between Treasury supply and corporate supply, I'm worried there's simply not enough. I've not had a single conversation over the last couple quarters with the client who said, oh, get me out of bonds. Every single one is saying, how do I get in?
Compare and contrast that with this from Peter Chia of Academy Securities. I remain convinced that none of the issues that made markets wonder who will ever buy treasuries again have been resolved and are likely to push longer yields higher. That is why I'm thinking that a 4.3% 10-year, which seemed bold at 3.8%, seems insufficient. Peter Chia, I'm pleased to say, joins us now. Pete, good morning. Morning. Compare and contrast your thoughts with what we heard from Bob Michael 30 minutes ago.
You know, I trade like much more as a contrarian style. So when we were at 450, we like 380. We got down there. We actually got below that. But I think some of the problems that were there back in the fall that were pushing yields higher are still there. I think it's going to be much more this time, again, about risk premium, term premium. I think 2s, 10s goes back to flat and maybe actually positive sloping, and that's what's going to put pressure on 5-year, 10-year, and 30-year bonds.
This is something that people are watching at a time when it seems like the enthusiasm just can't really be beaten out. What do you make of that? I mean, how do you basically say that the mood can shift that quickly if the data keeps confirming it?
One, go back when every single day we were looking at Chinese tick data. No one looks at Chinese tick data, and it continues to come down. So why did we stop looking at that? Nothing about the deficit increasing has really gone away. The cost of funds that it's going to cost, you know, the amount that's going to be spent on interest is still going up. So all those things are still there. People just forgot about it. Remember, we were watching every auction with trepidation. Ooh, is this going to be a good auction or not? Now we're going into one no one cares. And to me, as a contrarian, right, when everyone's worried, people...
I know someone. Bramo. Bramo still cares.
They've been messy, 5-year and 7-year.
Yeah, so I would not be surprised to see a little bit nastiness on the new 10s and 30s when they come out in February, and that could be maybe what triggers, oh, shoot, we got carried away with where we are in yields. And the front end is definitely controlled by the Fed, but I think the long end is going to be risk premium, fears, deficits, etc.
This is treasuries. You don't have this view on credit, do you? It's quite different.
No, I really like corporate credit. One, I think they did such a good job managing their interest profile, issuing longer dated bonds. And I really have been encouraging clients, especially in the 5-year and in, to be heavily overweight. If you manage a bond portfolio, say, against the ag index or a broad index, I want you to be heavily overweight corporates. I think from a governance standpoint, from all sorts of perspective, you're still getting paid almost free money to own some of these really high quality corporates in a world where the U.S. can't seem to get its act together on deficit, where people talk much more cavalierly about not paying debt on time. They'll ultimately pay it, but why bother with that when you can buy commercial paper, other products, and get a spread to treasuries, and I think actually have better governance and feel safer at night.
Let's take a step back. Bob Michael was talking about how if the Fed cuts rates, that will help the deficit problem because suddenly interest expense will come down and that everything will be back to that economic nirvana that we keep talking about. How concerned are you that they cannot do that? Because the more that we're talking about rate cuts, the more longer-term inflation expectations just creep up just a little bit.
I'm fairly concerned, but one, even on that, it takes a long time to move the average coupon on the U.S. Treasury debt, right? So much of it's long dated. So when I got bullish, when everyone was scared at 5%, part of it was, listen, it's going to take time for this to creep in, right? It's a lot of the debt's longer. The average maturity, I think, is close to 6 or 7 years. So it doesn't rise overnight. Similarly, okay, now even if we get back to 4% on Fed funds, that's still much higher than the current average coupon. So it will creep in. I think that creep is coming over time. We get fixated on what current rates are. You got to look at the average coupon, how long that takes to bleed in. And that's where we're headed.
Let's talk about the nature of academy securities. We do this often. You've got all this military intelligence there, generals sitting alongside you. Can you lean on some of that for us now? We're facing some real risk abroad, Middle East, in Ukraine, and I think there's some comfort with it. And the comfort with it comes from about looking at the commodity market and seeing crude in the 70s and not rallying hard, and assuming that this isn't going to touch us, this is not a big deal in US-based capital markets. Do you share that view, given what you hear every single day?
So let's run through it quickly. So we've got the 18 retired generals and admirals. I would say Russia, Ukraine, we're leaning towards that there might be some sort of a truce or something this summer. I actually think that's going to be inflationary. I think that's what people are missing. A year and a half ago, it might have been deflationary as Russia was going to sell in. Now you're going to have to really build up the infrastructure there. The one thing that I think doesn't get talked enough about in the U.S. is Europe is getting very concerned about the forced migration issue, and you're going to have people potentially putting their kids into school 3 years in a row in a foreign country. Are they ever going to go back to Ukraine? So I think there's a bigger urgency in Europe to get this resolved. So we think that happens. I think the Middle East is going to drag on. It's ugly. What to me is the real tell is Iran is selling about 3.5 million barrels of oil a day, well above what the sanction levels. I think we've been turning a blind eye to that, and because it does keep oil prices down globally. If something happens that we are really forced to engage Iran directly and cut back on their production, that to me would be a price shock. And then the final thing, and we've been deciding a lot, what's hedged, what's not hedged, I think the flight to safety will not work. So we've been working with clients, and the natural reaction traditionally is geopolitical event, bond yields go lower. I do not think that will happen this time, maybe at the front end, but not at the long end, and partly because I think everyone's very quickly saying, oh my gosh, geopolitical event, commodity prices probably going higher, deglobalization with China, increasing with every one of those. And finally, people are starting to realize war is going to be deficit spending. So I just think any sort of geopolitical event, we might get a small rally in treasuries. I would want to sell that because that, I think, pushes us above 450 when people realize the flight to safety is not the way to hedge this. I think you're supposed to be long commodities and commodity producers. That's my favorite part of the market right now.
When you look at inflation, you talk about the University of Consumer Confidence, and you say you haven't been able to figure out the value of the data as a reliable predictor of anything. We just played a soundbite of the Treasury Secretary yesterday talking about it. The White House has flooded our inboxes telling people to talk about it. What do you make of it?
So maybe I'm a bit biased. I did work with Bob Janjua for a long time, and he used to be classic. He would put consumer confidence, and it was con and capital letters on both, so con. And I find it tends to, fluctuate with oil prices, it fluctuates with stock market, they're still telephoning people. The whole thing just seems somewhat bizarre way to calculate it. People know the answers. And the only thing I find ever interesting is how quickly because you can get it by party registration, how much that deviates and changes on a dime when one party's in power or not. So to me, it's kind of fun and games, but I don't trust it.
So Democrats feel better, but Republicans don't.
Correct, but when Trump was in charge, it was vice versa. So it's always that way. So I find the data a little bit dubious. It's kind of fun and interesting, something to do on Friday mornings when it comes out, but I'm not paying much attention to it.
Yeah, welcome to our life.
I think it's fun. I want to be part of the cause for you, Mitch. I'm desperate to be part of the cause. I want someone to call me and actually go through the questions and say, where do you think inflation is going to be in?
And you're going to say 25%.
1 to 5 years. And then I'm going to see what they do with the data.
Yeah, right. And again, I'm not sure how many people are really thinking about these expectations, how it all comes about. So I don't find it. I know the Fed does like these inflation expectations, and they rely heavily on the trend and expectation. I just don't think, you go back even the last few years, they haven't done anything right, really. They haven't been horribly wrong. It's just data.
Peter Chair of Academy. Pete, it's good to catch up, buddy, as always. Peter Chair there of Academy Securities. Coming up next on the programme, we've got breaking economic data, personal income and spending, and core PCE deflator. All that data coming up. Mike McKee's going to break it down. We'll get the reaction from PIMCO's Tiffany Wilding. That's all coming up next. From New York City this morning, good morning.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The last big batch of economic data going into the Federal Reserve meeting next week. Equity futures going into it. The scores look like this. On the S&P 500, negative by 0.1%. On the Nasdaq 100, we're down by 0.4%. In the bond market, on a 2-year yield, shaping up as follows. On a 10-year, a 30-year. Yields high by a single basis point on a 2-year, 4.30.77, 4.30.35. On a 10-year, 4.11. Yields lower there by almost a single basis point. The economic data in America has dropped. Mike McKee around the table to break it down. Morning, Mike.
Good morning, John. Check the March Fed Funds futures, because we just got a 2-handle on the PCE core for the year. 2.9% comes in up 0.2 on the month, rounds to 2.9. First time since before the pandemic that we have had PCE core inflation that low. PCE headline 2.6, also a 0.2 gain during the month. That's the same as the month before. Personal income comes in up 0.3 for the month. That's a little bit lower than last month. And personal spending, a strong 0.7%. The forecast was for 0.5%. So we got some real strength in personal spending. That's not really a surprise, because we saw the retail sales numbers, but it does suggest that we had fairly strong services spending as well. So this will help ignite the debate again about how soon the Fed starts to cut rates.
No big moves in this market. I can tell you we're pulling back just a touch on the S&P, down by about 0.2%. If you check out the bond market, yields were a little bit higher at the front end, up another couple of basis points, up 3 basis points on a 2-year, 4.33. On a 10-year, up a single basis point, 4.13. In the FX market, the euro basically where it was before the data at 108.72. Mike McKee will catch up with Tiffany Wilding in just a moment. And a big focus for Tiffany and the team over at PIMCO, and others too, is this spread that seems to be emerging between what you get out of PCE and what you get from CPI. Can you walk us through both and talk to us about what this might mean for the Fed next week?
Well, it's an interesting thing, because the public tends to focus on CPI. The Fed's official target is PCE. Fed likes PCE better as a measure of overall cost changes. And there are some things in there that are different from the CPI, particularly housing, much lower weight in the PCE, and also some in the healthcare areas that comes in different ways. So you get generally about a 4 to 5 basis point spread between the two. And that has pretty much always been the case. But when the Fed says we want 2% inflation, they're talking about 2% that we're getting today with the PCE.
Bob Michael was on the program a little bit earlier. You asked us to ask him what he should ask, or what you should ask, rather. He talked about QT. QT was the focus for him, not rate cuts. Do you think we get some clarity on that?
Not a lot. But what I think they may say is that we've begun to discuss it. They need to, because they're getting to the point now where we're getting into that gray area of where ample is ample enough in terms of reserves, and we're seeing the reverse repo sort of fade away at this point. And so they're going to have to make a change at some point. And the question is, how do they make it? Do they taper? And that's the kind of thing they're going to discuss for a couple of meetings. So if they say they've discussed it, then that puts a clock on it, and that will be interesting for the markets.
Mike McKee, thank you, sir. Just to run through the markets, we'll go through stocks, bonds, and foreign exchange. At least there are no big moves here on the S&P 500, down about 0.2%. In the bond market, checking out a 2-year, 10-year, 30-year, Treasury shaping up as follows. Yields are higher by 2 basis basis points, 10-year 414, up by 4 on a 2-year 433.65. I know we've got to move higher on yields, Lisa, but nothing really in this data to change the conversation in a major way.
Basically, it's bang in line with expectations. The only surprise is that spending came in slightly above where people had expected, and it was revised upward in the prior month. So to me, that was notable because people keep spending at a time where people say that consumers are really driving some of the strength in the economy. How do we sort of depart these ideas or take apart these ideas of both more spending and less inflation? When does that sort of become incompatible?
And unemployment below 4%, but apparently not a reason to be hawkish anymore because you're not seeing wages run away.
So at what point is this a moment in time, to quote some of our guests, and not something that you could extrapolate out versus just basically the post-pandemic right-sizing that we're seeing just work through the system and create basically what we had before the pandemic?
What did Bob call it? Economic nirvana? For now, at least.
Yeah.
Tiffany Wilding with us, PIMCO economist and managing director. Tiffany, we would love your reaction to the data, and if we can build on the conversation that Mike and I were having. I know that you've been focused on this in a big way, the difference between PCE and CPI. What's your read of things?
Yeah, well, maybe just to start off by talking to what you guys were just focused on. You know, I think that one of the key questions is how much additional improvement, supply-side improvements can we get? And this gets back to how much additional normalization post-pandemic should we expect? And where will the economy be? What is the underlying trend in inflation once all of those pandemic-related effects fade? And we don't know that yet. We can try to estimate it, but we're not really sure what it is, and we're still kind of waiting to see that. And actually, in our minds, that plus the fact that demand in the U.S. economy still looks pretty strong might be enough to keep the Fed on hold for a little bit longer than maybe the markets were pricing. You know, and then there's the other issue of this core CPI versus PCE. You know, as you guys suggested, the measures are calculated differently. CPI doesn't look as good. We're at 4% still on a year-over-year basis, even though we've gotten down into that 2-point-something range with PCE. There's a lot of non-market factors, non-market prices that go into the PCE, as Michael McKee sort of suggested. And those are the things that are kind of contributing to the good news. So the Fed's kind of just getting lucky, frankly, on the PCE. We think the optics of the CPI, plus the fact that demand just continues to look so strong, probably will keep the Fed on hold a little bit longer here.
Yeah, I gotta say, I was talking to Joe Davis of Vanguard, and he was saying he's worried about this market, this economy, being something of a 1967 economy, or basically it looked like a soft landing. The Federal Reserve was able to cut rates, and then inflation picked back up again in a rapid way. What are you looking at to make sure that's not the case? What's the most accurate gauge?
Yeah, well, I mean, I think that's the thing, right? Like, you have to estimate it. You can't really observe it in some sense right now. And it gets down to how much inflationary pressures is a tight labor market producing. And as I said, because we've gotten a lot of tailwinds to inflation as a result of, you know, these supply chain improvements, we're not really sure what that is. So the models, there's various models that have been devised since the pandemic to try to estimate this. When our look at all of them sort of suggests that inflation absent a weakening in the labor market maybe is running closer to 2.5 to 3 on an underlying basis, which obviously is above the Fed's target. So those have been the basis of our reasoning that you probably do need some more weakening in the labor market. You need growth to slow for the Fed to really get back to 2% in a sustainable way. And we're just not seeing growth really slowing that much.
But in December, Jay Powell didn't seem to push back against market pricing, didn't seem to push back against this idea, seemed to frankly embrace the idea of a soft landing. Why do you think that's going to change and they're going to be less likely to cut rates in March, given that if you look at a year-over-year comp, at least in the past 6 months, you are seeing it back in that 2% range? And a lot of people are saying, you've got it. You could take a victory lap, as we were just hearing from Bob Michael.
Yeah, I mean, certainly their preferred inflation measure is definitely going to give them cover if they did want to hike rate, or excuse me, if they did want to cut rates in March. We think it's going to be running at 2.7. They're going to be pretty sure it's running at 2.7, that February data, you know, that we'll get right around that a little after the meeting, but we'll probably know the details of it.
So there definitely is cover for them to start to cut. And I think one of the questions here is, so we've done some historical analysis on central banks and when they tend to cut, and it basically suggests that central banks always tend to be too late. And they're not really cutting until their economies are already in recession and unemployment rates are up. So maybe knowing this kind of historical analysis, the Federal Reserve, instead of that kind of behavioral, historical way, they want to actually push against that and say, you know what, maybe we're going to get going now, but we're going to go really slowly. That's certainly possible that they could do that. And I think Waller suggested that kind of more recently. So we definitely wouldn't rule out March. It's a live meeting. I guess just for us, the balance of risks, still it's become more balanced, but maybe still is a little bit more on the side of inflation risks reaccelerating, which suggests to us that maybe a mid-year cut is more reasonable. And by the way, that's what we think is in line with the median for when we look at the summary of economic projections from Fed officials.
Tiffany, what's the consequences of easier financial conditions? And I ask this because that's ultimately why it matters, right? Is that if they cut, it could potentially ease financial conditions all the more with people pricing in another 8 rate cuts, which just seems to be the way that things go these days. So how much is that really contributing to your concern about inflation reaccelerating?
Yeah, so we have a housing shortage right now, and you have to, you have to keep in mind that higher interest rates, does result in both supply and demand within the housing market slowing, and we've seen that. We've seen housing market activity really collapse. So, one of the things is that as rates fall, you're going to see housing market activity re-accelerate, and that's going to provide a growth boost. And so the broader inflationary effects of that, I think you have to take those into account. We do think you're going to get some reacceleration. So that's why, even though the Fed, does want to start to ease, they do see inflation down. The way they do it is they're still going to have to try to manage financial conditions. So they probably are going to tell us when they start easing, it's going to be very slow, very methodical, right? And we don't want financial conditions to ease too much. But of course, the markets will extrapolate as they always do.
I don't want to make this too circular, but just to go into this a little bit more. So if the Fed doesn't ease or cut interest rates anytime soon and inflation keeps coming down, we had Matt Lazzetti at Deutsche Bank on with us recently, Tiffany, and he talked about that being passive tightening, just allowing real rates to increase. Is that offset by the broader easing of financial conditions that we've seen since October? Does one cancel out the other?
Well, so, if what is priced in to the bond market in terms of the path of the Fed funds rate, if that's not realized because the Fed's staying on hold longer, then that mechanically should tighten financial conditions. And I guess the question is, given how strong the economy looks, maybe financial conditions should be a little bit tighter. So, in our minds, that's a little bit of a reason to wait a little longer here. You don't want to get that premature reacceleration that could be inflationary.
Interesting. Tiffany, appreciate the update ahead of the Fed next week in reaction to that data, in response to the data just moments ago. Tiffany Wilding there of PIMCO. Just to get you up to speed on some of the price action going into the opening bell, about 50 minutes away. Equity futures on the S&P 500 shaping up as follows, with slightly negative by 0.05%. On the Nasdaq 100 down by about 1/3%, as if the data never really happened at the equity market. On the Russell, the small caps up by 0.5%. Yields did get a kick higher though, up by 4 basis points on a 2-year, 4.33 on a 10-year, up by 0.5 basis point to about 4.12. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. China's central bank has unveiled plans for targeted stimulus meant to guide money into specific sectors. The PBOC made the move after surprising investors this week with a bigger than expected cut to its reserve requirement ratio. Economists see the central bank following up by steering credit into select areas and making a handful of trims to the amount of cash banks must hold. And Salesforce is reportedly the latest tech firm planning to cut jobs. According to the Wall Street Journal, the company will lay off 700 employees, but is still looking to fill another 1,000 positions. Salesforce made more drastic cuts a year ago, reducing headcount by 8,000. The news comes as Google, Microsoft, and Amazon all announced layoffs in the tech industry this month. Liverpool manager Jurgen Klopp is stepping down. The football club chief said in an interview posted on X, he will leave the club at the end of the English Premier League season. Klopp has been at Liverpool since 2015, winning 6 trophies, including the coveted Champions League. He said he is, quote, running out of energy. And that's your Bloomberg Brief. John?
Yahara, thank you. Appreciate the update. Bramo on the phone right now, getting messages from home about Liverpool.
Yeah, it's sad. He was a beast, evidently. And
You're forced to watch this every weekend, aren't you?
I am. And forced to watch them win. And
Forced. Mohamed Salah is amazing.
Learning to love it or not.
Excited to sit down and watch that.
I mean, it's exciting. I used to play soccer, and it was called soccer.
So did I.
I'm not weighing in on that.
I was
I'm not going to weigh in on that this morning.
Left forward.
All right? Just going to.
Well, to Bob Michael's point, I'm reading now that the coach said he'll never manage a club in England other than Liverpool. However, he is still open to managing another team in the future.
Yeah, let's see if that's the national team. And that's what Bob Michael was talking about a little bit earlier. Coming up on this programme, less football, more on energy. The Biden administration keeping energy domestic.
It's an energy transition, and I believe that we've done that quite successfully and have allowed gasoline prices to come down.
A conversation just around the corner, live from New York City this morning. Good morning.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Live from New York City, equities totally unchanged on the S&P 500, just turning a little bit positive in the last couple of moments, going into the opening bell in about 44 minutes. Under surveillance this morning, the Biden administration keeping energy domestic.
I believe that we've done that quite successfully and have allowed gasoline prices to come down, which has helped food prices to come down because we are a farm to truck to table, not a farm to table. And we've also, at the same time, been able to accelerate the transition.
Here's the latest this morning. As U.S. oil production hits a record high, the Biden administration is halting new exports of liquefied natural gas, saying in a statement, quote, "This pause on new LNG approvals sees the climate crisis for what it is, the existential threat of our lifetime." Ellen Wald of the Atlantic Council warning against plans to stifle the U.S. LNG boom. Running Barron's, quote, "The plan would at worst halt future LNG exports that can strengthen our domestic economy and help our allies in Europe and Asia. At best, it will add unnecessary delays to America's LNG export growth." Ellen Wald, Senior Fellow at the Atlantic Council and author of Saudi Inc., joins us now for more. And we've got to talk about that and EVs as well. But let's start with the latest story this morning and the breaking news this Friday. What's your base case? You gave us your worst case, your best case. What's your base case?
I don't really think there is a base case. It's either they freeze all approvals, basically probably until the election, maybe until the next administration actually takes effect, or they continue to approve LNG export terminals. I mean, this is an impressively, amazingly growing industry. If you look at the upward trajectory of U.S. LNG exports from 2016, it has grown faster than any other country in the world, and we're one of the only countries that has more room for growth. If you look at Qatar, if you look at Australia, they're all leveling off. If the world needs more natural gas, we're the ones who are going to provide it.
Even with this move, though, Ellen, when you look at the market, the U.S. will still maintain the prime spot for LNG exports, right?
It will, but we do need to continue with that upward trajectory. We've got over, there's $100 billion in investments that we're waiting, in investments in LNG export terminals that were waiting to be approved at the beginning of 2023. We could double our export capacity just in a few years with the projects that are already underway awaiting final approval. So this pause to me seems to be incredibly politically motivated as opposed to based on any kind of environmental or climate concerns. We know that LNG displaces coal. We saw that with Pakistan. As soon as spot prices for LNG went up because Europe was buying more, Pakistan reverted to coal. So if we want countries to burn natural gas, which is a cleaner burning fuel than coal, then we've got to be prepared to actually supply it.
It does feel very political, and this morning Senator Joe Manchin is saying he wants a hearing on it. Senior administrative officials who briefed us on the decision said that they won't put a firm timeline. So is it your understanding that this is obviously just going to go past the election so the campaign could go out and talk about doing more for the climate and try to get environmental votes?
That's my sense, which seems a little bit odd considering they've already got plenty to stand on when it comes to the environmental picture. I mean, if you look at the timeline for approvals on these projects anyway, we're talking 330 days as an average. That's the longest time frame for approval that we've ever seen. Even the Obama administration only took 155 days to approve these export terminals. So it seems to me like it's really just coming at the specific behest of some climate activists, and whether or not this is really even going to impress anyone or impress any kind of environmental votes, it seems to me is a bit misguided.
And it's not necessarily just this issue. You were talking about how there's sort of a misguided type of policy mix from the administration when it comes to electric vehicles as well. And you were responding in part what we heard from Amos Hochstein. You wrote this: current policies are hurting demand for electric vehicles. Washington needs to unleash the power of the U.S. market by removing barriers to accessing capital, fast-tracking manufacturing, and promote domestic demand. Can you elaborate on how different what you think is necessary versus what is actually in place?
Yeah, so what we have this year coming into effect in 2024 is a provision of the Inflation Reduction Act that makes only certain electric vehicles that have certain battery components that are made in the U.S. eligible for the full federal tax credit, which is a fairly significant tax credit that could be very important for people when they're deciding whether to buy an EV. And only, I think, about 2 cars actually qualify for this. And that's because we don't really have a domestic lithium battery cell refining or production industry in the United States. All of that, or almost all of that, comes from China. We want to create this. We don't want to be buying Chinese products, and that's a very important thing to encourage. But by putting in place a regulation now that forces you to basically, it says you can't really buy these cars and get the full tax credit, but we don't have that industry yet. So in my mind, they're killing demand for EVs before the domestic lithium battery refining and production industry even got a chance to get started. They need to encourage demand for EVs, which will then encourage the creation of this domestic refining industry. But by killing this tax credit now, they're going to kill demand, and no one's going to even want to build an industry because there's no demand for EVs.
This raises a deeper question, Ellen, which is this whole question of what happens if BYD is able to sell their cars freely with no taxes in the U.S. Would that be good or bad for the industry? Yes, it would demolish the U.S. car companies, but it would actually maybe increase demand. What's your take on what kind of barriers there should be to level the playing field, as this administration says?
I think that there should be barriers to buying cars that rely entirely on lithium and battery components from countries like China that, have terrible environmental practices, basically use slave labor, and also dominate the lithium industry through very unfair trade practices. But we can't just assume that we can create our own non-China lithium production industry out of thin air. It has to be cultivated. And so in addition to having these tax credits available to spur demand, we've got to also encourage lithium refining in the United States. We need to make capital available for smaller businesses. We need to be able to fast track manufacturing for new innovative processes. If you look at the whole kind of ecosystem here, a lot of the innovation in battery technology actually comes from the US. It's just that China is doing all the grunt work. So what we can do, though, is encourage that manufacturing to happen in the US where the innovation is also occurring.
And I just want to jump in quickly. In about 60 seconds, if I could get your view on this. Wally Adeyemo, the Deputy Treasury Secretary, was with us a little bit earlier on the programme, and we talked about options. How do they ensure that automakers in this country, Ford, GM, Stellantis, Tesla, can compete with Chinese manufacturers? Are we going down the road of much higher tariffs, and can they deliver those tariffs given how dependent we are on supply chains out
on these products? And you've got to actually encourage us to have this domestic industry. You've got to make more capital available, more loans. There are all sorts of strings attached to getting these government loans and government funding to develop this lithium stuff in the US. Cut that red tape out so we can actually develop it so our cars can compete without the need for massive tariffs. Let's do that instead of just saying, oh, well, you only qualify for the full federal tax credit if your battery's made in the US. Oh, but by the way, we're making it really hard for you to actually make batteries in the US.
Ellen, appreciate your view on this subject. It's a subject we'll be talking about all year. Ellen Walder of the Atlantic Council. Ellen, thank you. AMH, big one for campaign season this year.
Absolutely, and there's a lot of hypocrisy in both these two stories. To Ellen's point, you cannot get those full tax credits if the batteries are not components made in the US or allies, so basically China. At the same time, this LNG move is a win for another adversary, Russia. So what is the administration doing? Are they leaning into climate, or do they care about national security?
Well, they've got to clarify the message going into the election season, that's for sure, because President Trump, former President Donald Trump, has his own views on this situation. Big week ahead for next week. Before we get to the weekend, one more trading day. I'll give you a flavour of Monday's show. Coming up on Monday, Dom Constam of Mizuho, Chris Harvey of Wells Fargo, PIMCO's Andrew Balls, and NYSE President Lynn Martin. All of that still to come next week, Bramo. Before we get to the weekend, we're looking ahead to the Federal Reserve.
Yeah, it's going to be a Fed meeting. It's also going to be a host of tech earnings, all of that coming out next week at a time where people are just really embracing economic nirvana fueled by an incredible tech boom that's going to keep the American exceptionalist dream continuing.
No snark there whatsoever. I'll say this, and I mean this. It's my favorite week for earnings, when tech earnings start to come through.
They come out after the bell.
Live from New York City, that's exactly why. That does it for us this morning. Thank you very much for being with us. Good morning. Enjoy your weekend.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I'm part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we could deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly, we want to be there for her, but it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California, San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. And this is a promising area.
Maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
From New York City, for our viewers worldwide, I'm Menace Crenny in for Jonathan Farrow. It could be day 7 of a rally on the S&P 500. Interruption by Intel for the NASDAQ. The PCE keeps dreams alive on rates. Countdown to the open begins right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
The equity rally prevaricates, disappointing Intel earnings. The White House tightening the economy while doubling down on climate. This as investors digest the key inflation figures ahead of the Fed. We begin with a big issue. Buckle up. We're in for a bumpy week ahead.
The Federal Reserve.
Its payroll's big. Max 7 tech earnings next week.
Tech earnings are supposed to be up in double digits.
From a profitability perspective, tech is likely going to be the sector that can deliver.
I think we're going to hear Powell more in this careful camp.
Officials will more clearly outline how they're thinking about rate cuts over the next year.
Is this a Fed that's looking to cut rates as early as March, or is this a Fed that's waiting to kind of take their time?
They'll move to a more kind of balanced language. They're going to be taking a read on that macro outlook to figure out when to cut rates.
We're looking at the data, and the data looks strong.
One of the key pillars to economic activity remains the labor market.
The labor market has been rebalancing in the U.S.
Under the surface, the labor market is cooling.
Look at how much non-farm payrolls have come down from 6 months ago, from a year ago.
There's improving prospects for a soft landing.
There is a path to a soft landing.
Joining me now, it is Nadia Lavelle of UBS, Morgan Stanley's Vishy Triputer. Join me. So here we are. The rates market has just had a fill signal from PCE. The equity market needs a fill or kill signal from tech earnings next week. As you look at the momentum in this market, record high 6th day in a row, credit spreads are narrowing. Are you all in on risk from here? Vishy, let me take it to you first of all.
I think there is a lot. I think a lot depends really on how the next week's data on both tech earnings and the employment data show what they signify. We are clearly firmly in the camp of a soft landing, and we have been for some time now, maybe early 2023. So that we continue to reinforce the notion that we are in a soft landing territory. But the challenge for the markets is much of the soft landing is already in price.
Yeah.
So given what's going on, given what's already in price, we would be threading the needle very carefully here.
Okay. Nadia, good morning. Good to see you. Is tech earnings the fill or kill for adding risk for you on the equity side?
It's important. I mean, of course, next week will be an important week because we have 40% of the S&P market cap reported. And of course, we have a bunch of macro data. So the macro and the micro data could cause some choppiness as the market really absorbs that. But we think that, pullbacks are going to be boring, and pullbacks are quite healthy for a bull market. We do expect tech to be able to deliver on the earnings next week. Some of our early checks are already pointing to that. So we think that this market can continue to be a grind high. Now, in fairness, the market is not too far from our base case scenario for 5,000 on the S&P 500. But when we look across our scenario, and I glaze over at that Goldilocks scenario, we're starting to lightly, at least half check some of those boxes, especially if the surprisingly strong economic momentum that we saw at the end of the year can continue in the first half of the year. And of course, the inflation numbers continue to surprise to the downside as they did this morning. You could see this market grind higher for the rest of the year. But we need to get through the earnings season to sort of determine the slope of that angle for that grind higher.
Yeah, and it was a jolt from, Intel, wasn't it, overnight as well. I think the best line I've heard recently has been, I've never met a wealthy pessimist. That was an asset manager who chatted to me recently when I said, I'm a bit doubtful about all of this. And he just said, I've never met a wealthy pessimist. Let's talk a little bit more about the numbers, the key inflation data ahead of next week's Fed decision. We are equipped. Mike McKee has gone under the hood. Mike, what we got?
Well, what we got is good news, at least for those in the equity and bond markets who are worried about what the Fed might do. It certainly takes any rate increases off the table to see inflation in the PCE index core drop to a 2 handle for the first time since before the pandemic. We get 2.9%. And the question is, does that continue? If so, it'll raise a lot of further questions about what the Fed does, and we'll get to that in a second. Personal income up 0.3%, and personal spending a very high 0.7, very strong is what I wanted to say, 0.7%. So Americans are still spending, incomes are still rising, and inflation is going down. That sets us up for what the Fed does, and of course we'll see their decision on Wednesday. Jay Powell at his last news conference suggested they're not waiting until they get to 2%. They'll start before that. The reason you wouldn't want to wait is policy would be too late. You'd want to be reducing restriction on the economy well before 2%, because if you get to 2%, you could overshoot, is basically what he's saying. So now that we're at 2.9 at least, and in the 2% range for both of the PCE indicators, is the Fed going to cut sooner? Well, the market doesn't think so. We've seen a reversal in the March rate cut odds, now down to the lowest that we've seen this week. Why might that be? Well, you look at the spending numbers and the savings rate, this personal income number, adjusted for inflation, only 0.1%, and the savings rate went down to 3.7%. So maybe there's an argument that Americans are going to peter out on their spending, but more likely it's the data next week. You guys were talking about how much we get, and of course we get consumer confidence on Tuesday, but it's Wednesday that's the big day because that's the Fed meeting, but also the employment cost index tell us more about wages and salaries and refunding. What I'm told is that's going to be maybe the biggest indicator of the week. Friday is jobs, but refunding is going to really matter to the debt markets. They want to see what kind of demand there is going to be and what interest rates are going to be, and that will affect everybody going forward in terms of where they think the rates are going to be. Thursday, Friday, as I mentioned, busy days with ISM productivity claims and January jobs, and so we'll keep ourselves quite busy next week.
Yeah, it is going to be sort of a filler kill moment for both rates and equities. Mike, thank you very much. Let's see, it's going to be a busy week. Nadia Lovell and Vishy Tiruptar are with me as my guests. Nadia, I want to go to you. It's interesting. I was chatting to one of the people on IB this morning. This is what he says to me. We've taken a full cut from the Fed out of the market since January. Yet risk assets, they just don't care a bit. When you look at the flow into American equities and into tech, that is true. Is there any sense of exhaustion?
You know, I think, as we know, the equity markets is pretty much forward-looking, and so it's the expectations that you will see rate cuts this year that's more important. We're looking for 100 basis points of cut this year, starting around May, and so we think that that will be positive for the market. Now, we think that the flows are still going to be strong into the equity markets. When you think about how much money is sitting on the sideline, particularly in money market funds, as the Fed starts to lower rates, those assets are likely going to be searching for better returns elsewhere, whether that be in the fixed income market and in the equity market. So that could provide a tailwind as we get into the back half of the year, as long as the economic data continue to support equities, which we think that it will.
Okay, I mean, it's a question of which home do you go to? Do you go to a little bit of bonds and IG, or whether you take the equity on board, Nadia, isn't it? Let's take that across to Vishy. When you look at credit spreads at the tightest in 2 years, again, I'm keen to get a comprehension of the scale of flow into credit. I know this is how I know it's a contrarian indicator. I'm even talking to somebody about the BlackRock IG funds myself. That's how low it has got that I'm actually interested in diversifying. That's a contrarian signal if I ever had one.
I think that's a good point. I think Nadia makes a really important point. This reallocation of money that's currently sitting, that has been sitting in the money market funds, is going to be a major story this year. We think that the better opportunity, certainly for the institutional component of the money market fund that is sitting there. So, in 2023, about $1 trillion got moved into money market funds. Mm-hmm. We think about 40% of that from institutional. We think that will find its way towards fixed income, particularly high quality fixed income. Even though aggregate spreads, as you point out, are tight, if you look at the components of the credit curve, the 1 through 5 year part is actually not as tight as, say, the longer end of the credit curve. So we expect to see more money flowing into the 1 through 5 year part of the high quality investment grade credit.
Just to square it away, a 1-2 punch from each of you. The PCE comes in at 2.9%. That is the preferred measure of the Fed. What is the risk of a March cut? Nadia?
You know, we cannot rule out a March cut. I think the market pricing in a 50-50 chance seems reasonable. Of course, we'll be paying close attention, as Mike McKee noted earlier. The ECI is important because the Fed has been highlighting that wage growth still remains too strong, and we want to see wage growth come down closer to 3.5%. So that will be key. But at this moment, we'll see what the Fed chair says next week. We wouldn't be surprised, and we know that the Fed has been reluctant to wave the victory flag, but maybe they'll start to raise it and let it blow a little bit in the tailwinds of the economy.
20 seconds, Vishy. Is it live? Is it really live? Is March really live? Would they dare?
We still think June is a more likely outcome and perhaps a greater risk of a May. There are some significant revisions to both employment data and to the inflation data coming up on February 9th. And also, then I think the near-term data, the 3-month annualized, 6-month annualized numbers may show some uptick in the first quarter. All of that puts us in the camp of June. Obviously, we'll be watching data. If data surprise and to the upside, if data changes, we will change our mind.
Okay, we change when the data changes. Nadia Lovell and Vishy. Tripita, stay with me, more work to do. Let's go under the hood, see what's moving. We've had some big moves from Intel. Abby, what have we got? Build the story.
We do indeed have some very big moves. It's interesting because the U.S. futures are very flat. But beneath the surface, to your point, let's start off with the shares of American Express. They're moving to the upside, up 1.5%. They missed in a small way for the quarter that was reported, but the 2020 forecast well above estimates, the range above the street profit estimate of $12.40 per share. Restaurants highlighted as a bright spot. You were just mentioning Intel, though. Look at that stock in the pre-market down 10%. It was a big beat for the quarter that was, but the first quarter coming in very short on both sales and profits. To give you an idea, 13 cents versus the estimate of 34 cents. So the turnaround maybe not sticking there. That could be the fear. Western Digital down 3.1%. They beat, but after a nearly 40% rally over the last 12 months, investors wanted more. And then we've had some breaking news in the last few minutes. Manus. If we take a look at the shares of JetBlue and Spirit Airlines, JetBlue popping, Spirit plunging. This after JetBlue warns that the Spirit deal may be terminable on or after January 28th. They informed Spirit Airlines that certain conditions to closing required by its merger agreement may not be satisfied on time, suggesting they do not want to go ahead with the appeal. We'll be, of course, waiting for more information on that story.
Yep, and also there's a whole host of debt rollovers to consider in that story. Abby, thank you very much. Coming up on the show, the White House taking a victory lap?
We have seen some turnaround in sentiment in recent months. I think Americans do believe inflation's under control.
From inflation to energy, the Biden administration tightening the U.S. economy and freezing approvals for LNG exports. Why now? That conversation up next.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're
in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
We have seen some turnaround in sentiment in recent months. The University of Michigan Consumer Sentiment Index has moved up quite a lot. Inflation is now near term at close to the lowest levels we've seen in that survey. So I think Americans do believe inflation's under control.
Secretary Yellen there tightening the U.S. economy. This is the White House hits the pause button on approving new natural gas exports. President Biden writing in a statement, this is what we had from him. We'll take a hard look at the impacts of LNG exports on energy costs, America's energy security, and our environment. Now, this pause on new LNG approvals sees the climate crisis for what it is, the existential threat of our time. Interesting time to make this decision. Kaylee Lyons is in D.C. Will Kennedy is in London. Kaylee, good day to you. This is a very interesting political moment to make a call like this. Bold and differentiating. Your take.
Yeah, Manus, it's interesting that this move is happening in an election year, and this is really the launch of a process that could take months, lead us up potentially to that election in November that is now just over 9.5 months away. Essentially what the Energy Department is doing here is analyzing energy, climate impact, economic impact, national security impact of these exports, because the current assumptions that they are using in this approval process haven't been updated since 2018. And officials say that there is evolving information on how exactly methane burning is impacting global warming, essentially. So that is what they're reanalyzing here. This is a process they are not putting a firm timeline on, but they have indicated it could take months. They're going to do it expeditiously. It's not going to affect current levels of LNG exports. It's not going to disrupt projects that have already gotten approval, but it could potentially delay approval for other projects that are out there. The real political calculation here for the president is a difficult one. On the one hand, there is pressure from the left, from environmentalists, to consider climate change more heavily, and the concern being that if you are putting infrastructure, long-term projects together for exporting LNG, that means you're going to be weaning off of it way later. This is something that's going to be taking place for generations to come, potentially. Then there's the pressure on the right to not put climate ahead of American jobs and the overall U.S. economy. So it's a very difficult calculation here. Clearly, though, this is something the administration is moving forward with. There's also the question about what ramifications it may have geopolitically, as the U.S. has made a commitment to help Europe essentially not be dependent on Russian gas in particular because of Russia's invasion of Ukraine. And there's a question as to how much this could disrupt those efforts, Manis.
Yep. Katie, thank you very much. As you say, those promises to Europe have massive political reverberations. Mr. Kennedy, how are you doing? Not only have you got OPEC to contend with, this must be music to the ears of the Qataris. I mean, they're side by side. They are with the U.S. in terms of the #1 exporter. So if the U.S. steps back, it's hello market share for the Qataris.
That's exactly right, because the Qataris are going full steam ahead to increase their export capacity by about 60% over the next few years, and they're looking to sell that gas around the world, including to Europe. I do think the decision, as Kayleigh said, will be a major concern in Europe. Europe has successfully stopped importing Russian pipeline gas, but it's only been able to do that because of the flow of US LNG. And if those exports are capped at a lower level than people were expecting, that means that gas is going to be more expensive than it may well have been, and that will be good for Qatar, but another blow to the European economy, which is struggling to compete with other parts of the world on energy costs.
Okay, well, it's certainly going to have massive ramifications at the energy complex, the price of a gas at the pump here as we go towards the elections. Geopolitics, I don't think necessarily is a vote winner in this country. It's all about what's in your pocketbook. Katie Lyons, Will Kennedy, thank you very much. The energy complex discussed there, Nadia Lovell and Vishy Tour with me this morning. I mean, translating those high-level policy moves at this stage is very much about how it'll play out perhaps in the head-to-head with Trump. But I want to get a perspective from you, Nadia, first of all. We have this pressure on oil prices and pressure on OPEC Plus perhaps to extend their cuts. Your view on the energy market as it stands right now?
Yeah, you know, we have a modestly positive outlook on energy equities and oil at the moment. Of course, it's been a volatile time, and the conversation is shifted towards supply for this year and whether there will be an oversupply market. We don't think so. We still expect a slight deficit in the market for the first quarter. We think that OPEC Plus will extend those production cuts into the second quarter, and that should help support prices. And so we're looking for Brent price to get back to about $85 this year, and that should also help support the equities. But again, it's going to remain volatile and things are fluid, and a lot of it is going to depend on how the rest of the winter season progresses. We're already seeing some supply disruption from the U.S. side, but so far into January, it looks like OPEC Plus exports have been coming in lower than in December, and so that's flowing through.
And Vishy, from your perspective, from the fixed income perspective, the dissipation in oil prices in the back part of the quarter to a certain extent helped, I'm not saying it was the only reason, but helped with inflation expectations settling a little bit better. There is a risk here. We're taking up 76.81 is where we are on WTI. There is geopolitical risk in this market. So to what extent can oil be an interrupter in the break-even or the inflation outlook?
We think not a tremendous amount. We think it's our expectation, and oil is outside of my direct realm of expertise. My colleague Martin Ratz's expectation, who is our commodity strategist, has a mid-80s price book for Brent over the course of the year, and a relatively range-bound expectation there. And what I think is really our market, the fixed income market, is going to be more focused on is really what the services component, perhaps core services ex housing, the core PC, core service ex housing, in all of those calculations, at least directly, oil prices are not going to be that material. And in this range, as long as we're in this range, it's not going to be that material. I think that's what the market is most focused on, and looking at the potential upside. The road to the inflation going down is not going to be a linear, straightforward road. It's going to be a bumpy road. And the source of that bumpiness, we think, comes not so much from energy, probably more likely to come from core services ex housing.
Yeah, I mean, the services is where we are seeing that stickiness prevail. Thank you to both of you. That is Nadia Lovell and Vishy Tirupta joining me this morning on the markets. Coming up, your morning calls. A little bit later on, we've got Max Kettner, see whether he still has his clarion reverse Goldilocks call. Why investors need to prepare. That conversation with Max in just a moment.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Interrupted. In the space of 30 minutes, we just sweep into the red on the S&P 500. Intel is just breaking the will to live on the NASDAQ, down 0.5%. Intel down 11%. Let's get you up to speed with your morning calls. Will it change your mind what the analysts say? First up, TD Cowen upgrading American Airlines to outperform, expecting the shares to benefit from upcoming Investor Day. Next up, Deutsche Bank upgrades Snap to a buy, pointing to a strengthening in the outlook for the airline. Advertising. Finally, Oppenheimer upgrading Coinbase to outperform, listing a handful of catalysts that are on the horizon. Brace, brace, brace. I'll take you on a bumpy ride to Goldilocks land. Max Kettner has a warning for you and the investors out there. Don't chase the equity rally. That conversation with Max next.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rain World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond. Equity markets reflecting on services inflation, which is a little bit sticky. It's Friday, the day that records come to die. We've had 6 days in a row of rally. In the past 30 minutes, we're giving it back, down a tenth of 1% on the S&P 500. Intel is a car crash on the guidance. Gensler's got to do an awful lot to guide this market. You've got euro dollar pipping up by an eighth of 1% at 108.64. Did you really think Lagarde meant that she was going to go earlier than the summer yesterday? Oh, look, they got ticker tape at the NASDAQ today. That is very cool. Bright spring. They're a happy crew at the NASDAQ today. We're up on yields, up by a pip. The headline PCE comes in sub 3%, but it is the services part, which is the highest monthly change in 3 months. You'd hardly call it exorbitant, ticking up on the 10 years. And crude is down by 0.5%, 76.98 is where we trade at the moment. One stock that I mentioned, it is Intel, and the chip maker is sinking. You've got disappointing forecasts, to say the least, renewing uncertainty around this stock. Abigail Doolittle has the detail. Abby.
Well, Manus, we have this stock plunging worst day since October of 2021, and it's one reason that we have both the S&P 500 and the NASDAQ snapping a 6-day winning streak, because it is the biggest weight dragging on both of those indexes. So they actually put up a good quarter, but to what you just said, the outlook, especially for the first quarter, very disappointing. They're talking about $12.2 billion to $13.2 billion in revenue versus the estimate of $14.25 billion. So a pretty significant miss there. Profits, 13 cents versus 34 cents. So more than a 50% haircut there relative to expectations. Now, the chip maker's personal computer business is recovering, but demand in the lucrative market for data center chips is not so strong. In addition, they are contending with a slowdown in programmable chips and components for self-driving vehicles. They've also talked about getting into the foundry business. That seems to be stalling. There's not a lot of information there. All of this puts that turnaround that you were talking about, a fledgling turnaround, into question. We have at least one downgrade on the stock to a hold from a buy over at, I believe it is Raymond James. I'm just trying to pull that up right now. Needham, actually. And the stock up more than 60% into today over the last year. They need to put up more. They could not miss the outlook like this, and we have the stock, again, plunging on the day.
Yeah, and you've got their original customers designing their own chips, so it's a tough world out there. Abby, thank you very much. Let's stick with the earnings theme. Visa's robust results, they're being overshadowed by January's weak trends, but a more optimistic response to Amex. Simone Foxman has the details. Simone.
Yeah, Manus, the investors, at least this morning and early trading, seem to be more focused on the outlook than they are on the latest quarter results. We got news from both of these companies today. Visa actually performing a little bit better than expected in its last quarter, but some of these results and some of the trends that I was seeing in January may be related to some negative weather, kind of overshadowing the picture for the year. So it saw quarterly profit up 8% year on year. That was ahead of expectations. Revenue up 9%. But the CFO is saying that this is a short-term blip in January. However, Jeffrey is saying, steep acceleration for the year, low double-digit growth. We're going to need to see the company really come back from that after a slow start. Amex, however, missing estimates, but seeing a stronger outlook than anticipated, boosting its quarterly dividend as well. So maybe we're seeing some of the response there. From a macro perspective, though, both companies saying they see a very strong consumer. They're projecting that throughout the year with double-digit revenue growth. Also should be noted, Visa hit an all-time high yesterday. So maybe some of the response is people just taking profits here, Manus.
Yeah, there's always that. Plus, I've yet to get an Amex card as well. I've still got my Visa. Simone, thank you very much. Simone Foxman there. Let's turn to transportation. Norfolk Southern is missing their estimates for the fourth quarter, marking an end of what the CEO calls a challenging, transformational year. Isabel Lee is with me. Do the investors believe that? Not really at the moment.
Not really at the moment. Shares are lower, around 3%, Manus. It wasn't a good cycle for Norfolk Southern. The railroad operator reported a drop in operating income, and that's dragged by another $150 million last year that resulted from the derailment of their trains in Ohio. And the company also reported an adjusted EPS that was lower than estimates. They reported $2.83. That's slightly lower than the $2.87. Its railroad operating revenue also fell around 5%, as well as the merchandise revenue, which is around 1% lower. For the year, the company is targeting a revenue growth of about 3%. So maybe that's where the transformational part enters. On Thursday, we have some bad news. The company announced it's laying off 7% of its non-union workforce, and that's amid just a tough freight cycle. By some calculations, this would translate to around 330 people in their workforce. For now, Norfolk shares are down 3% in the past 12 months. It's also lower by 1%, Manus.
Isabel, thank you very much keeping a track of the earnings there. Excuse the pun. Let's turn to telecoms. T-Mobile's earnings missing the estimates. Despite strong gain in subscribers, Katie Greifeld has been tracking the mobile. Katie.
It's pretty much a mixed morning, I would say, for T-Mobile. You take a look at the shares right now, currently a little bit under pressure. You had fourth quarter EPS. It missed estimates. It came in at $1.67 in the quarter. Analysts had been looking for $1.91 there, so a bit light. And that's really overshadowing that good news that you mentioned on the subscriber front. T-Mobile, it actually added 934,000 phone subscribers in the quarter. That is well ahead of estimates. Analysts were expecting 886,000, and it also outpaces peers AT&T and Verizon, which also reported gains when it came to subscribers. While analysts are praising the growth and the quarter overall, they seem pretty rosy about this report overall. They did note that share buybacks did not meet expectations. You also had churn a little bit higher than expected. But to get into some of the commentary, you had Citi writing that while there were some, quote, bright spots and some wrinkles in this report, more good than bad, you also had Morgan Stanley Simon Flannery noting the less than robust expected buybacks as mentioned, but he also wrote that he continues to see T-Mobile as leading the industry with significant share gain potential to come in the smaller markets. Maybe that's helping the stock rebound a little bit right now, currently down about 1%. We had been closer to about 2% lower pre-market, Manus.
Okay, Katie, thank you very much. HSBC's Max Kettner listening into the roll call of results and the macro flow. But he delivers this warning with this. While it may be tempting to chase the latest all-time highs, we maintain our view of reverse Goldilocks. If anything, 2023 has taught us not to chase, but to fade the trends. Max Kettner has never been one for the crowds, but I will challenge you. Good morning. How are you? Good to see you. So look.
Good morning, Manus.
Record after record on the equities. Credit spreads are on the tide. Strong U.S. growth. China stimulus. Tell me where the cracks are.
Yeah, look, I think the cracks are perhaps that inflation is a bit stickier than we thought, right? In fact, when we look year to date at the risk asset rally, it is not similar to what we had last year. Last year, right, it was almost enough that we had this tech-driven rally in U.S. equities and U.S. large caps. And that was sort of propelling everything higher, from emerging market debt to high yield credit or high beta effects. When we look at those asset classes since the start of the year, well, the reality is when we look at emerging market debt spreads, they're up 20 basis points. High yield spreads are up 10, 15 basis points in the US. When we look at things like EM local currency debt, that's down 2.5%. The Russell is down 2.5%. So it's really just those handful of stocks that are driving the gains. But under the hood, we are starting to see some of those cracks. And I would say it's perhaps that we're getting a little bit too comfortable with inflation completely disappearing. And on the other hand, we see that in the pricing, right? We see that, for example, short-dated inflation expectations in the US, they came down from sort of 2.70 down to 2% in the last 2.5, 3 months. We saw that when we look at, for example, global equity performance, compare that with earnings revisions. I would argue, look, even if the reporting season now is good, and even if what you guys were discussing just now, even if the guidance of most companies turns around and is actually much, much better from now on, most of that is now in the price, right? Most of that, even if earnings revisions do pick up, that is now priced in. The same thing goes for valuations. We know that PEs have gone up, but that was mostly really a function of lower yields and lower rates volatility, but that's been largely played out now. So I do question, what is the catalyst up from here?
Okay, you question the catalyst up, which then makes me cautious about what I have in my exposure. My question is, do I de-risk from equity and take, you talked about the sort of the pop, slightly pop, I wouldn't call it a hectic move, Max, on high yield, but do I de-risk in equity and high yield and go for IG over high yield until there's better clarity?
Yeah, I think so. I think that's probably the right strategy. So you want to sort of hide out in short duration stuff, right? Short duration IG credit, particularly in the US, because bear in mind, the environment that we foresee, which we're sort of calling reverse Goldilocks, or call it bad news becoming good news, those sorts of backdrops, they typically argue for a stronger dollar, right? So if you're hiding out in shorter duration credit, for example, in US dollars, that tends to work quite well as a hedge. We do still think that energy prices can trend higher from here, right? So we're not bearish on all the risk assets per se. In fact, our view is not a classic risk off. It's the exact opposite.
And you and I spoke about this before. So maybe the slightly more challenging question to frame to you is this: how long do you think? How enduring will reverse Goldilocks be, Max? Max, do you think it's going to be a period of time, Manus, until I see rate cuts, stabilization, syncopated drop in inflation? Does reverse Goldilocks is it a front-loaded 2024 scenario plan?
Yeah, I think that's true. It's not going to be a view that will pan out throughout the entire 2024, right? Look at the last year, for example. You were just reading some of the stuff that we put out in a note this week. The fact is, when we look, for example, 12 months ago, people were playing US recession for a month or two, and then for 2 months we played banking crisis and credit crunch, and then for 2 months we played debt ceiling and Treasury general account. Then we played Goldilocks for 2 months. Then we played higher for longer. Yields can never go down anymore, right? We played that for 3 months. And now we played for 2-3 months, we played the whole Goldilocks theme. And, just going through that from the last 12 months, it really taught us, look, probably this is not the environment anymore like it was in the 2010s, where you want to chase those trends, but where you want to say, look, the next one is going to be perhaps exactly the opposite. And that's not going to take 6, 9, or even 12 months. It could easily be coming, snapping back very, very quickly, perhaps even next week, right? With some of the, perhaps there'll be some more disappointing news from the tech sector because the expectations are so high. Maybe the Fed does put some wording in around the easing of financial conditions that makes them a little bit uncomfortable, right? What about the quarterly refunding announcement on Monday, for example? What about non-farm payrolls, wage growth, right? Wage growth also on the employment cost index. So there's quite a few things that under the hood, I think, could be questioning that super dovish pricing now, and the exuberant pricing in equities with regard to valuations and earnings.
Okay, so I hear you. I've got the lines from the report. Hide out in a bit of cash, short-dated credit, and you like Japan equities and energy. So that is what you like. What is it that would cause you to rewrite the top line on the research note, which goes, prepare for reverse Goldilocks? What is it that backs that up? What is it that makes you rip that off and go, okay, I'm turning?
Yeah, I think one of the things that we really need to look at is sentiment and positioning. When we look, for example, at our sentiment and positioning indicators, yes, they have gone down. You've seen that also in survey-based sentiment. So you've clearly seen, I think, since the start of the year, talking also to our clients around the world, I think most clients on the discretionary side are sort of neutral, really trying to figure out what's going on. Is that really going to broaden out? Is it going to broaden out into other asset classes, into the broader sectors within equities as well? Whereas on the systematic side, when we look at positioning of CTAs, of risk parity funds, of volatility target strategies, the reality is, on our measures, that is almost maxed out long. So frankly, all I need right now is I need a bit of a turn in shorter term momentum. And once that turn in momentum comes, then, you know, those strategies, those systematic strategies really will turn very quickly from net buyers and buying pretty heavily to actually pretty heavy net selling, right? And that can go very, very quickly. And that really would be, for us, one of the triggers really on that reverse Goldilocks coming pretty quickly.
And then can I just take you to the other side of the barbell? What would be your greyest swan?
Yeah, I think especially for a view like ours, right? I guess the biggest risk is that the next couple of weeks, next couple of months, we're going to continue to see data like we had last week, right? Or even yesterday, when, you know, GDP rises more than expected. You look at the number and your first reaction is, oh God, like, can't we see really 6 rate cuts this year with such a strong growth number? And then at second glance, you look at the inflation side and you're saying, it's great, right? We're back to target on some measures, even below that. So if that continues, if in the next couple of months, we're going to continue to see, you know, better than expected growth, but inflation basically gradually going towards target without any kind of disruption, that I think it's basically Goldilocks on pretty much, you know, the next couple of months. And it still then argues for tech and for AI and a continued rally across everything.
So before I let you go, what's the style of jacket? This is the full kind of very beautiful German tailoring, is it? What's the name on that?
It is underlying my Bavarian nature. You know that, Max.
Bavarian nature. You'll just see Max somewhere near to you with a... What's the name of the thing you drink out of a stein, is it?
Oh, yeah. That is called beer, Manus. That is called beer.
Okay, this is going to descend. I'll see you soon. I'll see you in America for a beer soon. Max Kettner there with his reverse Goldilocks, but he's open to change. Coming up, wrapping up the big week of earnings.
LVMH is remarkable in that its fashion and leather goods segment added in incremental sales the entire top line of Tod's, Ferragamo, and Burberry put together. That's just how much it grew on top of a very big base already.
The monster that is Louis Vuitton. Earnings season heating up. Next week, big tech on the deck. That conversation next on Bloomberg.
When you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
I do think what we are going to find is that outside of a very few industries and sectors, governments are not going to be willing to subsidize indefinitely production that brings it home or brings it to allies. And so the benefits of international supply chains that we've seen over 40 years, from economies of scale, from specialization, from innovation and the like, those aren't going to go away. And so if you don't have an international supply chain, you will be beat out by competitors who do.
So I think what we're looking to do is to maintain a trade policy which is based on openness,
which is based on sustainability, which is assertive, where we need to be assertive and defend our rights, but certainly not one which is going to be closing down unnecessarily our trade and investment relationships with the rest of the world. Globalization, that open supply chain, global supply chain is really important for the life science industry, particularly pharmaceutical supply chain. You think about the stress the pharmaceutical supply chain has been under since COVID-19, the war in Ukraine, not to mention the geopolitical tensions, if you will. You know, we don't have the luxury of saying we can temporarily stock out on our product, because these products, these medicines keep people alive.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
If we look at kind of scale, LVMH is remarkable in that its fashion and leather goods segment added in incremental sales the entire top line of Tod's, Ferragamo, and Burberry put together. That's just how much it grew on top of a very big base already. So that is what has insulated its operational leverage relative to its peers. And I think that's also important in that many companies in the sector delivered outsized margin expansion in the wake of the pandemic.
That is a heck of a moat around one brand name in the luxury sector, showing signs of resilience. It is LVMH delivering better than expected results. Shoppers treating themselves to the brand's luxury handbags and clothes. Organic growth was monumental there. Simone Foxman is with us. So much for the aspirational shopper. They're not interested in them right now.
Yeah, it seems that the luxury shopper is carrying the day, and shares up the most since 2009 on the back of these results. Really reassurance for the street in the wake of some of these concerns about weakness in the high-end goods industry overall. Note that LVMH had hit a 14-month low yesterday, but fashion and leather, 9% organic growth in the fourth quarter. Wine and spirits expected to sink 7%, but then seeing an unexpected 4% surprise after 2 quarters of declines, especially on the back of that slowdown in the United States. So overall organic revenue growth up 10% year on year. The estimate had been for 8%. Management also hitting a very robust tone. A lot of analysts across the street noting that, confident in their 2024 despite some of the geopolitical and macroeconomic headwinds. The CFO also said, though, that they don't plan further price increases in 2024. Citi says this tone indicative of the idea that 2024 could be a smooth normalization rather than the difficult one that many had been anticipating. Able to weather those winds of U.S. slowdown, able to weather those winds of Chinese consumer, and that's why we're seeing that positive bump in shares today, Manus.
Yeah, you call that normalization with swag. Simone Foxman there on Louis Vuitton numbers. From retailers to big tech, we get the results from 5 members of the Magnificent Seven next week. The preview, Katie Greifeld has the curtain raiser. Katie.
Manus, buckle up because we have a big week next week. In the coming 7 days, you have 108 companies in the S&P 500 taking the stage. That amounts to $16.8 trillion in market cap, making it the busiest week of earnings season. So let's name some names here, because on Tuesday you have Alphabet, you have Microsoft reporting, then you have Apple and Amazon on Thursday, as you can see on that calendar, and then Meta closes us out on Friday. And like you said, 5 of the Magnificent Seven just there alone. And traders will be watching to see if that group can overcome the ills of Tesla. The EV maker really whiffed on earnings this week. That's adding to a 25% loss already in 2024 for Tesla. And the Magnificent Seven as a whole, it's managed to actually hold up despite Tesla's performance, but obviously the next few days are crucial to determining whether or not that dynamic is sustainable in the long haul. And don't forget, in addition to big tech earnings, we also have a Fed decision and a jobs report, so it's going to be a lot of fun, Manus.
Yeah, a heck of a lot of fun, Katie. Thank you very much. Looking ahead to next week. For some of the sector price action, let's get back to Abigail Doolittle. bit of a guess here. Maybe tech might be under pressure.
You're right about that. That, of course, is the worst sector on the day. On Intel having its worst day in more than 2 years. As a result, we have the S&P 500 actually looking at a small decline right now, the first time we've seen that in 7 days. To the upside, though, is consumer discretionary up 0.5%. Whirlpool, Tupperware, along with Tesla, all helping out there. As for the week, let's take a look at the best two. And it's a little bit of a surprise here, actually, to me. Energy is the best sector on the week, followed by communication services. And then to the downside, we're looking at consumer discretionary. I think that has a lot to do with Tesla's fall yesterday. And then healthcare, a small decline. But on the week, Manus, we are looking at a 1% gain right now, at least, for the S&P 500.
Okay. Keeping the dream alive maybe for the week. Abigail, thank you very much. Coming up, the market-moving events that will dominate your diary. That's next.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
This is Bloomberg.
Record run up on these stocks is interrupted. Do you really want to take that much risk going into next week when you've got the Mag 5 reporting and nearly over $60 trillion worth of market cap hitting the tape next week? Do you want that risk on your book? Well, let me tell you what you do need to know to focus for the week. Tuesday it is Tech Mountain. Earnings come in from Alphabet and Microsoft. Wednesday, you have the Fed's decision and Chairman Powell's news conference, guidance on the inflation and rates. The Bank of England, it's their turn on Thursday. And then more and more tech, Amazon and Apple and Meta earnings pile in. Finally, the crescendo of the week, the payrolls report with wages, jobs, and all you need to know about the health of the U.S. economy. It's Friday. We got there. Nothing quite broke. Perhaps interrupted on this equity rally for now. Countdown to the open Friday. That's it from me. This is Bloomberg.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in?
I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Friday morning from the Bloomberg Interactive Brokers Studio in New York City to our worldwide audience. Alex Steele and Paul Sweeney with you here in the Bloomberg Interactive Brokers Studio for another edition of Bloomberg Intelligence Radio. Over the next couple of hours, we're going to focus on markets, company news, where we're going to highlight the investment research of Bloomberg Intelligence and its analysts. BI's 400 analysts around the world cover more than 2,000 companies and 130 industries globally. So we get to tap into those fine folks throughout the next couple of hours. Coming up, we're going to take a look at regional banks, plus global transportation. I think we had a lot of railroad companies report earnings, and those companies are always a great vibe for what's happening in the economy. Plus, we'll talk about the municipal bond market because it's Friday, and that's what we do. We talk muni bonds. We'll also bring you an interview with Intel CEO Pat Gelsinger. That's going to be with Bloomberg's Ed Ludlow around 11:20 a.m. Wall Street time. But first, let's kick things off with a Bloomberg Business Flash. John Tucker.
All right, and this Bloomberg Business Flash being brought to you by Interactive Brokers. IBKR's redesigned Fundamentals Explorer provides comprehensive worldwide fundamentals data to clients at no cost. Take your research to the next level. Visit IBKR.com. Let's start you off with the data, and this is kind of an eye-opener. Pending home sales on a month-over-month basis coming in way better than expected for the month of December of 8.3%. Expectation was for 2%. Prior month, that was dead flat. Earlier, the Fed's preferred measure of underlying inflation, the PCE data, that reached an almost 3-year low. Bloomberg Economics says the stage is now set for the Fed to start cutting interest rates, perhaps in March. The major stock averages, they are mixed right now. We have 8 of the 11 major industry groups in the S&P 500 higher. Biggest drag is coming from information technology. Well, Intel's disappointing earnings shouldn't weigh on the rest of the market. At least that's according to Patrick Armstrong at Plurimi Wealth.
Not for me. I think it's an Intel issue. I think the market is really rewarding companies that are price setters. Unfortunately for Intel, they've fallen into a bracket where nobody's clamoring for their chips. They're producing commodities.
Right now, the S&P 500, 4 points lower after another record close yesterday. 48.90 on the index. The Dow Jones Industrial Average, 30 points higher. The NASDAQ 100 right now, that's down 94 points. That's a decline of 0.5%. And the 10-year yield, the benchmark, 4 basis points higher. We're at 4.16. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Alex and Paul.
Hey, John Tucker, thank
Happy
you so
Friday.
much. Happy Friday,
guys.
absolutely. We're all in on that.
5 days. I made it a whole week.
Yes.
And I'm still here.
Exactly. It's all working
It's a win,
fine.
guys.
It's all working fine. Alex Steele, Paul Sweeney live with you here in the Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Alex, the economic data, I'm just thinking the last few days, I got a GDP print of 3.3%, much better than expected. And then when the PCE data comes out, people like Michael McKee and Lisa Bromwich, the smart people, tell me to focus on the PCE core deflator. That was 2.9%, better than the 3% forecast, and down from the 3.2% last period. So I've got a strong economy with GDP, inflation coming down. Isn't that a soft landing?
Well, also, what I like to look at, because I also like to shop, is the real personal spending, because that's the real underlying data that kind of goes in, and it's up by 0.5%. And also they revised November up too. Sure, that could be Christmas shopping. We don't know, and sure, but it's still growth, and it just defies all the expectations of a recession and a consumer slowdown that people are still clinging to, but yet we have not seen.
Haven't seen it here, and so the markets are kind of mixed on this data, as John was just reporting. Let's go under the cover a little bit and see what's happening on some of those equity markets. We welcome Nora Melinda. She covers equities for Bloomberg News, and she joins us here in our Bloomberg radio studio. Nora, what are you looking at?
Well, let's take a look back at Intel, which John spoke a bit about earlier. Looking at Intel, that chip maker is seeing a double-digit sell-off this morning after reporting a disappointing forecast on first quarter sales and profits after a long-promised turnaround from the once dominant chip maker. Those shares are down as much as 12% for their worst single-day drop since June of 2020. This spillover is really causing a broad-based weakness among chip maker stocks. We're looking at the SOX index being down, information technology being the worst performing group in the S&P 500. Though the chip maker's personal computer business is recovering, demand is weakening in the lucrative market for data center chips. And, on the flip side, this has really been a struggling company. So some analysts are saying, maybe this should have been some expected news. But the company is still contending with a slowdown in chips and components for its self-driving vehicles. And of course, we'll have Ed Ludlow speaking to this later.
Yeah, that'll be about around 11:20 a.m. Wall Street time. Ed Ludlow, Bloomberg Television, sitting down with Pat Gelsinger, the CEO of Intel. So stay tuned for that.
It just seems like patience. If you want the stock, you just got to be patient. They're building out the foundries. That should be good for them. They said that they had $10 billion worth of, quote, lifetime deal value. I have no idea what that means, but you just got to be patient to wait for it, and then you get the margins back. What else are you looking at?
Let's take a look at T-Mobile. It's a bit of a mixed report here this morning. We have Citigroup analyst Michael Rollins describing it as some bright spots and some wrinkles. Shares were earlier under pressure, but are now rising as much as 1.6%. The phone company reported fourth quarter EPS that missed expectations, and there was some disappointment in regards to share buybacks. But the company has also reported some solid fourth quarter results, including postpaid phone net additions of 937K. Analysts were expecting 886K. This beat both AT&T and Verizon's results, suggesting that it's gaining share with its industry-leading 5G network. I don't know who you guys have, but I've heard fantastic things.
T-Mos.
Okay.
You're T-Mos?
And I need to get with you. I'm with Verizon.
Yeah, I've always been a Verizon person.
I was a Verizon user, and then I got sucked into T-Mobile because of the deals they were offering were really good, and it cut our bill in half.
Wow. Really?
And then I got my dad on my plan for similar reasons. They had terrible customer service at Verizon, so we're part of this trend.
I need to get with you.
Interesting, because we just had a story about how parents are still supporting their kids. They're living at home longer. And I made the statement that my 3 working age children are all off the dole. They're all on their own. I feel pretty good about that, with one exception: the phone. We have that big family phone thing.
Yeah.
And I put out a text to the gang. I said, hey, you guys are all off on your own now. Do you want to, do your own phone gig, or do you want to stay on? And they all came back, even though one, says, well, we'll stay on.
And that's me.
Yeah.
I'll stay for as long as I can.
I'm the opposite. I got my dad on my plan.
Oh, good.
Yeah, so it's
I
a
love
different
that.
kind of story. Okay, so you have a third stock. What's moving? What is it?
Really quickly, looking at Spirit, another double-digit move.
Spirit.
Yes. Those shares are tumbling as much as 21%. The airlines are really still in focus, yet again, after JetBlue finally filed a notice that its $3.8 billion deal with Spirit may terminate in the next 2 days. JetBlue said that it's still trying to evaluate other options, but this filing comes after both carriers did say earlier this month that they would appeal the federal judge's ruling that blocked the deal. And this is all just after days after JetBlue's new CEO clung to the deal with few other options. Her priority is really set on returning JetBlue to solid profitability.
Ah,
Sure.
interesting. Well, my question is,
dream.
if I'm an airline person, if this deal doesn't go through, what happens to Spirit? Like, did they go away, I think? Because that's what I understand about their balance sheet.
Compete
They've got balance sheet issues that if this deal doesn't happen, I don't know what happens to these guys. And if you're in those markets, that really depends upon Spirit Airlines. I don't know. These regulators are tough.
Yeah, I
on
mean,
deals in general.
Well, it's also just, unless they can hold on if we get a new administration in November.
Yes.
And then does that change the calculus?
Right. Yep.
But I don't know how you even hang on that long.
Yep, interesting. All right, great stuff, Nora. Thanks so much for bringing us up to date here. It's time to take a look at some earnings, and some earnings for the regional banks, because around this time last year, there were some issues. And around that time last year, we met this guy named Herman Chan, and we haven't been able to get rid of him since. Herman Chan is the regional banks analyst on Wall Street. He works for us at Bloomberg Intelligence, and boy, do we depend upon him over the last years. We're trying to really get a handle on what's happening with the regional banks in this country and what types of pressure are they under. Herman, thanks so much for joining us once again here in studio. We're back into earnings season for some of these banks. Tell us what you're seeing and maybe what you're hearing from investors in these regional banks.
Yeah, thanks. Regional banks have largely completed fourth quarter earnings at this point. I'd say it's more the same. Revenues are still off about 2% on average. Loan growth's not really there because there's lots of weaker demand, especially from commercial borrowers, and banks aren't really doing a lot of commercial real estate lending at this point, given a lot of potential risk ahead for that particular asset class. And so banks are focused on button down expenses and building capital. So there's not a lot of good news, at least in fourth quarter results, but banks are expecting a return of loan growth later in 2024, and that's really a function of lower interest rates increasing demand.
How are their deposits doing?
Deposits are pretty stable.
Because that feels like a big bright spot.
That has been an area of concern, particularly after the regional bank failures of SVB, First Republic, and Signature Bank. But at this point, banks have lifted interest costs and made deposit pricing more enticing for depositors across the board in money markets and CDs. So that's really the area of growth for the regional banks, but they're still seeing attrition in those, zero cost deposits, the deposits that are in checking accounts that aren't generating any sort of interest for customers.
So one of the tickers I learned a year ago from Herman was KRE. That's the Spider S&P Regional Banking ETF, a great proxy for regional banking in the U.S. Year to date, that's flat.
Right.
Trailing 12 months, down about 10, 11%. So the question I always have for you is, I work for a hedge fund.
Right.
I want to go into my hedge fund manager. I'm a hotshot young analyst covering in regional banks. I want to go in and say, give me another 50, another $100 million, because I think it's time to go long regional banks.
Right.
Are we there yet?
If you went long at the end of October, that was like that was the time, right?
Okay.
That was the time. That was like sort of the inflection point. The banks were at the trough valuation levels, and then the market sort of turned around and expected robust interest rate cuts, and so the valuations of the banks have started reflecting those rate cuts, and the market's a bit more optimistic for regional banks, largely because when rate cuts happen, you have lower funding costs and sort of potential growth in the balance sheet, as I mentioned earlier. So that could help
It's a
improve
35%
sentiment.
move off that October low.
That's
for this.
right. So
Okay.
that was the time to get in. At this point, a lot
Where
of
were you in October
the
for?
easy money. You should have brought me in
Yes.
October. I would have talked about it.
No one wants to talk about it when they're doing well.
Yeah,
right?
exactly.
So Herman, another issue was those hold to maturity bonds, right, and the
Right.
disconnect between
Right.
deposit and the short versus long-term maturities. What are they doing to fix that? I mean, do they
Right.
need to? Are they offloading loans to, say, other big banks? What are they doing?
Yeah, so there's a few dynamics going on. One is that with the longer term rates coming down, those unrealized losses are actually improving. So you've seen book value growth because of the lower paper losses across the board for the industry in the fourth quarter. A few of the banks have recently started selling these loans at a loss and then reinvesting at higher prevailing rates. So you take the upfront hit, but then you improve your net interest margin and your earnings power going forward by reinvesting at current yield. So that's a strategy that's happening. Maybe that happens a little bit less with interest rates potentially coming down going forward.
So other than that spate of a handful of banks roughly a year ago, have we had any other notable bank, I don't know, not failures, but just angst? Yeah.
Yeah, the angst was really relegated to those three. There were a couple banks like PacWest that was in the headlines, and that found a buyer in Bank of California. Another bank that was definitely in the headlines was a bank, as you recall, Western Alliance, that they have done a tremendous job of shoring up their deposits and really getting back to the good graces of the market. So there's no real concerns there, and they actually reported yesterday after the close, and the stock's up 2%. So favorable results in the fourth quarter. So at this point at the stage, it seems like the rest of the regional banks seem in pretty good standing.
All right, let's talk about one of my favorite topics, Basel III Endgame.
Oh, yeah.
Right.
Mostly because it just reminds me of the Avengers, and I love that movie. But, okay, so this is basically higher capital requirements for certain banks. And if you're the big guys, you got to put in a certain amount. And if you're sort of the medium players, you got to put in a certain amount. What's going to be the hit to the let's call it $100 billion to $250 billion regional banks?
Yeah, that's a very good question. You hear of the bank CEOs like Jamie Dimon be very vocal about it being the Basel III Endgame being very negative for the U.S. economy and hurtful in areas like mortgage lending, et cetera. So, but for the regionals, it's fairly digestible. The big hit for the regionals is that their capital ratios will suffer from these unrealized paper losses that you asked about earlier. So that will be incorporated into their capital calculations, whereas that aspect is already in the big bank's capital. So some of the tailoring issues that happened during the Trump administration will go away and be detrimental for regional banks. But outside of that, the issues that the big banks complain about, it's more manageable for the regionals, and for the management teams for the regions have talked about risk-weighted assets growing, in the low single digits to the mid-single digits. So that's much more digestible relative to a 40% growth in RWAs that JP Morgan has talked about.
So you mentioned during a year ago when people were really concerned about this group, it's really going to be an earnings issue as opposed to kind of a balance sheet issue. Where are we in kind of getting through that earnings pressure, if you will, and maybe getting back to more normalized earnings power for these companies?
Yeah, that's right. There's still pressure on the margin because even though short-term rates, the Fed stopped raising rates at this point, there is still a trickle-down effect where, as I mentioned before, there is a mix shift happening from your demand deposits, your checking accounts, and moving into areas like CDs. So that deposit remixing is a negative for earnings and revenues, but that's petering out. Offsetting that is fixed rate repricing of loans and securities, so that's beneficial. So overall, revenues are going to stabilize and are starting to stabilize. That's happening. Potentially, that's going to be a second half event. So you're going to still see some headwinds, but manageable, with the second half potentially growing from better margins and balance sheet growth.
Herman, so great, so smart, best stuff out there. We're sorry we only have you on when there's a disaster for the banks. Herman Chan, Bloomberg Intelligence Senior U.S. Regional Banks Analyst. Herman Chan joining us there. I do have to wonder, Paul, like, where's the M&A that we were all like? There's been some.
I know.
But I wonder why it hasn't materialized.
Again, I've got
a
a buddy I ride the trade in with, and he's been a longtime M&A banker for regional banks for years. And he said he deferred his retirement for a few years because he thinks he's going to do a ton of business. His wife's not happy, but he's like, I think I'm going to make a lot of money here. So
When's that going to happen? Know. He's like riding the train. He's like, where's my M&A?
Yeah, so he's still riding the train, waiting for the M&A to kick in. We'll have more coming up. This is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Well, let's start off with the tale of two stocks. Intel, the worst performing stock in the S&P 500, down over 11% after its earnings report. And then you have American Express surging the most in a year. The credit card giant forecasting earnings for 2024. The top estimates, Amex right now the best performing stock in the Dow Jones Industrial Average, up over 7%. Data today, the Fed's preferred gauge of underlying inflation cooling to an almost 3-year low, even with pretty robust holiday spending. And then there's a shuffle at the top. J.P. Morgan Chase Chief Executive Officer Jamie Dimon moving some of his top lieutenants into new senior roles, so he's positioning them for more experience running the firm's operation as he prepares potential successors. Right now, the S&P 500 dead flat, 48.93. Dow Jones Industrial Average up 61 points. The NASDAQ 100, 73 points lower. And we check the markets for you all day long, right here on Bloomberg Radio. And I'm John Tucker. That's your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele, Paul Sweeney. We're live here in the Bloomberg Interactive Broker Studio. We're streaming live. It's actually streaming now after a little glitch this morning. So you can just head over to youtube.com, search Bloomberg Radio, or go to the search Bloomberg Podcast. That's another way to find us as well. So, Alex, back in the day, I worked for a little investment bank, not a little, regional investment bank in Richmond, Virginia, Wheat First Securities. My office overlooked the beautiful James River and the railroad tracks running right along the James River. So all day, every day, trains carrying coal from West Virginia to Newport News for export to Europe would run by. So I love trains. So it was a great office, the top office of all time in my career. Down in
Alex,
Virginia.
what happened?
What happened?
He's here with me now.
What
So
happened?
clearly, what is better than that?
Exactly.
No, I would have loved that too.
It was
Planes,
awesome.
trains, automobiles, 100%.
Yep. We had a lot of the train companies reporting some earnings, so that means we have to check in with Lee Klaskow. He covers all the transportation stuff for us, trains, trucks, ships, the whole thing, air freight, does it all for Bloomberg Intelligence. So, hey, Lee, thanks so much for joining us here. Again, export coal, that's the dirty stuff. We'll send that to Europe. The clean stuff out of the Powder River Basin in Wyoming, which I've been to, by the way, that stays here. What are you hearing from the railroads this quarter, Lee, so far?
Yeah, so it's been I wouldn't really call it a mixed bag. We've had pretty much most of the rails beat expectations that have reported. There's one left that hasn't reported, Canadian Pacific, but Norfolk Southern reported this morning, and they missed. They missed by 4 cents, and you can see the stock is down around $6.50 right now. And really driving that weakness is not so much the miss, but it's their outlook. You know, they're expecting their margins to improve 100 and 150 basis points annually over the next 3 years, but consensus is at a 250 basis point improvement. So consensus is pretty much in line where management is expecting revenue to come in, which is around 3% growth, but it's really on the cost side. And you know, this railroad has been dealing with a lot of additional costs. They were made headlines, unfortunately, earlier last year due to that devastating derailment in Ohio, which created a lot of chaos. The good news for them is that, you know, they are really focused on improving their operations. With improving operations also comes improved service and safety. That's all been doing quite well, but it also comes with higher costs. Norfolk Southern is trying to build a more resilient network. So next time, you know, something like this happens, and let's hopefully it never does, but, you know, it's an outdoor sport and things can happen when operating a railroad that are kind of beyond their control. But, you know, it allows them to kind of bounce back. And the management did mention on the call this morning that they got some kudos. You know, I guess they wanted to highlight some good news that they had from some of their customers, because a lot of rails faced some serious weather in January, and they were able to snap back a lot sooner than maybe some of its peers because of this resiliency that they're building into their network. And again, that comes with higher costs.
So, Lee, that's a Norfolk Southern story, which in some ways had idiosyncratic stuff going on. But you also had Union Pacific, you had CSX, and both of them had a cloudy outlook also for 2024. What's our macro read-through for that?
Yeah, so we've been in a freight recession for quite some time. There has been no soft landing for the freight markets. Weakness kind of hit in 2022. The good news is that we could have some growth this year in 2024, but that growth is going to be probably pretty anemic. It can be anywhere between low and mid-single digits. So the outlook is mixed because it really depends on the commodity type. So the demand for automotives is still strong. Intermodal.
I was going to say, aren't we spending and buying lots of stuff?
We are buying lots of stuff, but a lot of that stuff is coming from warehouses versus coming from overseas. So while inventory levels are getting normalized and the destocking cycle appears to be over, it doesn't really seem that retailers or other businesses are looking to build inventories, just given the uncertainty that we're facing from an economic standpoint. I mean, we all know that, at least from consensus estimates, that economic activity is going to be moderating this year versus last year. And so, again, with the mixed bag, Paul mentioned export coal earlier. Export coal was a fantastic business for a lot of these carriers last year. That is expected to cool. Utility coal is really going to depend on the weather and where stockpiles are. So that there's a lot of uncertainty around that. And you mentioned the idiosyncratic story of Norfolk Southern. The thing about railroads is while there are some like macro overarching themes, each railroad operates a different network with a different mix of businesses and different benefits. And so it really becomes a rail on rail story versus an industry story. But the one overarching theme that I would say is that volume is going to be better this year. Margins are probably going to be better this year, and that should drive earnings growth.
Alex, one of my first gigs back in the day was I covered the railroad and trucking industries.
How many jobs have you had?
Oh, I've been around. And my first
can't
earnings
hold the job, apparently.
I can't hold the job. That's very true. Lee, my first earnings models, you could still take a look at them, but they're on floppy disk. So I'm not sure how we necessarily get access to them. Lee, do you care? Do you have a preference, Eastern railroads versus Western?
That's a great question, and what I would say is that I do like Union Pacific, which is the only pure play Western rail. The Eastern rails are Norfolk Southern, CSX, and the reason why we like Union Pacific, and that's one of our focus ideas in Bloomberg Intelligence, is that we believe that their new CEO Jim Vena can do a lot with the company. He joined, I believe, back in August. He was their COO, left, and he's really known for being a great operator. Canadian National was one of the first railroads to